Hello and welcome to our multi-asset webinar. I'm Danny Hewson. I'll be leading you through the next couple of hours. We've got a great bunch of speakers who should be able to shed some light on what lies ahead after what's been a kind of year which would make a pretty good foundation for a Netflix movie. It's been great to have so many people join us on the road earlier this month. We appreciate many of you couldn't join us for multi-asset seminars, which is why we're hosting the online session to share the content with as many people as possible. Now, the session is being monitored, so please make sure you watch to the end in order to qualify for your full structured CPD time. We will email out certificates and a copy of the slides in the next couple of days. Comments can be made using the chat function. We'll collate those and come back to you after the session. And a feedback form will pop up at the end. You can use that for any questions for any of the speakers. A copy of the recording will be hosted on the Info Centre, so if you think any of your colleagues would like to watch it or you want to recap on something. There's going to be a chance to take a quick comfort break, grab a cup of coffee halfway through, but for now, make yourself comfortable and we will kick things off. It's time to hand over to one of our homegrown speakers. Russ is a favourite at these multi-asset seminars. He has a huge amount of experience. Starting as a fund manager back in the day, I won't age him, for a leading provider of life insurance. He was appointed AJ Bell's investment director in the summer of 2013, and he's now something of a fixture on a whole host of broadcast media, discussing the potential outlook for economies, markets, and portfolios this year. Ladies and gentlemen, Russ Mould.
Hello, I'm Ross Mould, AJ Bell's Investment Director, and today I'm going to talk to you about the Magnificent Seven and what they might mean for markets. Now, yes, I am a fan of old westerns, although there is the more modern version that you can see here on the right-hand side, but I'm a little bit more of a fan on the left. And clearly the most important question that you'll get in any pub quiz is who were the actors who played the Magnificent Seven? We'll come back to that at the end, but I'll give you the Yul Brynner and Steve McQueen for starters. So we're going to very quickly run through this and have a look at what the markets are telling us right now, and then more importantly, what they might be telling us about the future and what the potential implications for client portfolios are. But we'll talk very quickly about what's already happened, because I'm particularly good at that, what's been changing, how that may shape the future, and then how, using the Magnificent Seven, we can perhaps judge what may be coming round the corner. So to repeat, this is the bit I'm brilliant at. Hard to beat me on telling you what has happened past tense. So in 2022, it seems like a long time ago now, gas and oil were the best performers. Bitcoin was tail end Charlie, and it was pretty tough sledding for both bonds and for equities. On a specific stock market basis, emerging markets had the edge in 2022, Brazil and India. Actually, the UK didn't do bad, and you could argue, given the political eruptions, that was starting to behave like an emerging market as well. But more seriously, NASDAQ was the tail end Charlie, as tech stocks came under pressure thanks to rising interest rates, but it was pretty tough for most major markets. But then if you look at 2023, the picture's flipped around. Bitcoin has gone from worst to first, oil has hung in there, but natural gas has gone from first to worst. Bonds have still been finding it very hard work. Equities have got a little bit of traction, though that's been primarily because of the United States of America, and we'll come back to that. And again, in terms of the specific equity markets, it's been tougher for emerging markets this year. The worst performer from last year is, again, the best performer this year. That's the NASDAQ. Japan's been holding up very well, doing very well because its central bankers will come back to as a major outlier, still keeping interest rates in negative territory, still running quantitative easing programs. Hong Kong and China have struggled to shake off lockdown. And again, that's been some of the emerging market malaise. So the big question is, what's caused that massive flip? Bitcoin worst to first, NASDAQ worst to first, natural gas first to last, and emerging markets losing momentum. Well, first of all, if we'd been doing this a year ago, we'd have been talking about really not much else beyond recession and how it was seen as a bit of a racing certainty. Well, it hasn't happened. Even the UK has managed to duck one. Yes, there are still concerns over Germany, but in the third quarter, the American annualized GDP growth figure looks like it could come in around 6%. Now, that may be down to fiscal pump priming and Bidenomics, but whatever's causing it, America is still growing, and it's growing much faster than the markets are expecting. So the recession and earnings downgrade fears of last year, they've not come true. Central banks, consumers and corporate margins have also caught a break from the natural gas price going down, and oil still actually below where it was a year ago. So that's removing again a further tax on margins and on consumers. That's also helped inflation, and that's cut these lovely people a break. Jay Powell, Andrew Bailey, Christine Lagarde, and Kazuo Ueda, the new Bank of Japan governor, because they've been able to start slowing the pace of interest rate increases, or in the case of Mr. Ueda, not even start interest rate increases. And that again is still got financial markets thinking, well, if the rate of increase is slowing, that means we're going to get to a peak. And once we get to a peak, that means we're going to get to a pivot and rates are going to start going down again. So although those hopes for rate cuts have been pushed out, they're still there, and that is still providing some support to equities as well, potentially. So we can see here how the pace of rate rises has slowed. 367 global interest rate increases in 2022 against just 17 increases. This year we're nudging up towards 150 rate rises, but the pace is definitely slowing, and we have seen more cuts. We're up near around 50. Now earlier in the year, the countries who were cutting, it really was the company that you wanted to keep because they were generally economically struggling, predominantly emerging markets, Africa to a many degree, but also China. However, more positively and constructively recently, we have seen Brazil and Chile cut rates, and that was because they were really early to move in the fight against inflation. They didn't go for any of this transitory flannel that the American Central Bank, the Fed, and the Bank of England went for. They went straight into, this is a potential problem, we have to act. Act they did, and they moved rates up very quickly and very promptly. They may now be reaping the benefit of that and starting to cut rates, something that may be worth bearing in mind if you do discuss emerging markets with clients, because emerging markets have had a very tough time this year. But if EMs are now in the vanguard of rate cutting, that might be something that starts to work in their favour. However, central banks are still putting the squeeze on when it comes to quantitative tightening, something we'll come back to when we talk about fixed income and bond markets. This chart here aggregates the balance sheets of the Fed, the Bank of England, the Bank of Japan, the ECB, and the Swiss National Bank, translates them all into dollars, and you can see how quantitative easing and bond buying programs have massively bloated their balance sheets. They went into overdrive during the pandemic, 2019-20, but they've been at it for a very, very long time. But as we can see here, they've started, with the exception of Japan, to reduce their assets, either by just letting them roll over and not reinvest, or in the case of the Bank of England, even possibly tentatively start to sell. The Fed's withdrawn about a quarter of the stimulus monetary-wise it poured on during the pandemic, and we can now see that these big fives aggregate balance sheet about 10% smaller than it was a year ago. Will it ever get back to the 15 trillion mark before the pandemic? I'm not so convinced. Will it ever get back to the 5 trillion mark we had before the great financial crisis? So you can still argue in many ways monetary policy is still very loose, and that again could be helping risk assets, though this QT, as we've now got it quantitative tightening, is causing ructions in the bond markets, as we will come back to in a second. But nevertheless, the mood music here is changing, but it's perhaps not quite as awful as some would have been expecting. And here we are, bond yields. They are rising. In fact, since I drew this chart barely a week ago, they've gone up further still. The outbreak of another conflict in the Middle East is giving a little bit of a bid now to fixed income instruments, and treasury and government bond yields are coming a little bit down again. But the story this year has been one-way traffic in 2023. Bond yields up, bond prices down. Why? Inflation has been one. Central banks threatening to keep interest rates high for longer is two. But again, equity markets are looking for that pivot, even if fixed income markets aren't. And three, government debt, which we will come back to, continues to grow, and that could mean more supply. And let's face it, if there's more supply at a time when price insensitive central banks have stopped buying and may even start selling in a price insensitive way, well, if supply is up and demand is down, there's only one logical conclusion, which is price down, yield up. So we'll see how that goes when we'll come back to debt later, because it may be the key story that underpins the whole global outlook right now. But bond yields up does mean now that the TINA, there is no alternative story when it comes to certainly the search for yield. Now, economists and strategists are using the word tiara. There is a real alternative. It could even be bonds here. It could be infrastructure, because as prices have gone down, yields have become more attractive, and even cash may appeal to certain more cautious clients right now. But this has been a key theme on the fixed income side: inflation high for longer, galloping debt, but maybe a bid now courtesy of Middle East uncertainty. So where do we stand? Well, as we suggested, equity markets are still almost really pricing in a Goldilocks scenario, a return to the low growth, low rate, low inflation mush that we saw in the 2010s and early 2020s. And that's why you've seen tech come back this year, for example, and it's certainly why you've seen US equities hang on in there really pretty nicely. Will we go back to that after 15 years of extraordinary monetary stimulus and huge amounts of fiscal stimulus in the past 2 or 3 years? Maybe. Just feels a bit convenient and a bit pat. So I'm not completely convinced. So if we can perhaps put aside Goldilocks, we still have 3 possible options. And the tricky bit for advisors and clients is that all of them, if the history is any guide, and I accept the past is no guarantee for the future, but if market history is any guide, they all require a different portfolio solution. And I can make a compelling case for all 3 of them, as I'll now very quickly prove. Maybe you'll find it compelling. Inflation, as we just said, huge amounts of monetary and fiscal stimulus over the last 15 years. Money is sloshing around. That in itself is potentially inflationary, particularly as velocity starts to accelerate. Onshoring or friendshoring. Globalization, with the entry of China into the World Trade Organization in 1994, there was a big move to stop employing expensive people in the West and start employing cheaper people in emerging markets. Now, maybe that process is reversing for good employment reasons in the West. Fantastic. But people in Birmingham, Alabama, or Birmingham, the UK, are going to be a lot more expensive than people in Bangladesh. That is potentially inflationary. It does protect supply chains, it protects jobs, but it's potentially inflationary because it means higher costs. Energy, very much a wild card. Oil prices, in focus, and gas prices in focus since the Russian invasion of Ukraine, where it made clear that relying on Russian supply perhaps geopolitically wasn't smart. We've also seen a return to conflict in the Middle East. Nothing like what we've seen in 1973 or 1979 in terms of the implications for supply, but let's keep an eye on that. Thankfully, Israel is not to be selfish about it, and there are far more important things to worry about than financial markets and oil prices when it comes to the humanitarian cost in the Middle East. But from the selfish perspective of financial markets, Israel is not a big oil producer. It does have gas fields, but at the moment there's been no impact on oil supply. But relying on Russia, not good. Energy security, big issue. And we have told oil companies not to drill for the last 10 years. Please don't knock holes in the ground. Please don't produce things that add to the hydrocarbons in the atmosphere. So oil companies have not done so. We have not been expanding our oil supply for several years or looking for new fields to anything like the previous degree, but demand for oil and gas has continued to go up. So supply not up, demand up. Pretty clear what's going to happen. Prices up. And you're seeing that not just in oil and gas, but also uranium. Lots of talk right now about how nuclear may be one of the solutions going forwards. That's why the uranium price is going tonto, $70 a pound, up from $40 a pound a year ago. And that's based on the sheer number of nuclear facilities that are now being talked about over the next 10 or 20 years, including those in the UK. Energy could be potentially inflationary, particularly when, yes, the move to renewables is ecologically desirable, we're all told, but you are potentially moving from a high source of energy return on energy invested to a lower source of energy return on energy invested, wind renewables, away from hydrocarbons, and that's tricky and again potentially inflationary. So if we did get inflation, we can look back to the UK in the early 70s or the US in the early 70s, and what works then from a portfolio perspective, real assets, things that central banks couldn't print or conjure out of the air, commodities, minerals, property. Short duration assets like miners, value and cyclicals did well. And Index Linkers had their moment that I know, I had an investment, Kevin Duran has got things to say about that. In terms of deflation or at least disinflation, I know the unions right now are probably having the most power they've had in a good 40 years in terms of generating wage increases for their hard-pressed members, but the long-term demise of unions has traditionally been held up as a source of disinflation. Maybe that one's changing and going into the red column. Demographics, potentially deflationary, disinflationary, as people live longer, save more, spend less in the short term. And tech and productivity, inherently deflationary or disinflationary. Moore's law, we get the same computing power, for half the price every 18 months. And heaven knows what AI is going to do going forwards. Rare examples of this, thankfully, 1930s, Japan since 1990s. Then you need to be in paper assets. Cash, as prices fall, the value of cash rises. So cash, bonds, long duration assets, long duration bonds, and also things like tech and biotech, which are in theory capable of generating growth regardless of the economic backdrop, whether it's low growth or not. Stagflation, worst of all worlds, quite rare. Thankfully, the UK in the 1970s is one of the rare examples you can find. Too much debt, too many zombie firms hogging capital, not doing anything with it particularly effectively, misallocation of capital, too much money sloshing about in the wrong areas, and again, possibly energy prices contributing. If you go back to the 70s, it was a rotten time for investing. The FTSE All-Share troughed on a P of 3 in the 1970s. It's currently on a P of about 10. That was one of the rare decades when gold really shone. And also from an equity perspective, you needed anything with pricing power. Anything you stuck down the throat, stuck down the sink, or regrettably used to defend or attack your country or attack somebody else's with, they did very well indeed. Thank you very much. So 3 possible scenarios plus Goldilocks, 3 possible outcomes, 3 possible portfolio solutions. Maybe we need to think about a mix of them all because none of us know what's coming. But the one that central banks don't want and the one that we really can't afford is the middle one, deflation. The debt that we have is just too big. The burden will become too crushing if prices were started to fall and the value of money was kind of technically, relative to debt was rising. That would be an absolute nightmare. So just as we saw in 2007-9, just as we saw in 2020, central banks and probably governments will move heaven and earth if there is any danger of deflation, whether it would be cutting interest rates, more QE, or whatever, or financial repression. That's the one they don't want. So I would say on balance, if I was to have a guess, an educated guess, hopefully, that'll be the one that's least likely of these 3. So we're looking down the other sides, perhaps. So how do we judge which of those scenarios is coming? Well, this is where we come back to the Magnificent 7 and the next 7 charts through which I will rattle very quickly. So this chart is currently saying equities think we may go back to Goldilocks, low growth, low rate, low inflation, mush. How is it saying that? This chart aggregates the market cap of the Magnificent 7 tech stocks like Microsoft, Meta, Apple, Amazon, Alphabet, for example, Netflix, and looks at their combined market cap and the year-on-year change in that, the grey line, and compares that to the year-on-year change in the S&P 500's market cap. And as you can see, there have been times this year when all of the gain in the S&P 500 has come from those 7 companies, seen as growth stocks. Therefore, market saying we think growth's going to chug along, but not too hot. Rates will be not too hot. Inflation won't be too hot. Happy days. Growth stocks back in charge. What you really would like to see, I suppose, that if you're more in, or expect to see if you're more in the inflation or stagflation camp, is more breadth in the S&P 500. I would also suggest that this narrowness is normally, this bad breadth, as it were, is not normally a good sign for equity markets, because there's too many people huddling in too few companies. The S&P 500 equal weighted index is down for this year. The S&P 500 overall is still below its 2021 high, as is the NASDAQ. So even the US equity market might not be quite as thrillingly healthy as it may seem at first sight, but really what you'd like to see in the US at least is a bit more breadth. But this is the equity market saying low growth, low rates, low inflation, happy days, that's where we're going back. As I've said, it just feels too packed to me after 15 years of extraordinary monetary policy and extraordinary fiscal policy. This at least is suggesting that we're going to get, again, this is equity saying the world is a good place. This is trains. Yes, I like old westerns. I also like trains, planes, ships, automobiles, and trucks, because when the Dow Jones Transportation Index is doing well, you can pretty much guarantee the industrials are doing well. Why? Well, if goods are being sold and the economy is strong, then they have to be shipped and shelves have to be replenished and stock has to be shipped to replenish them. And it's good news, therefore, to see from an economic perspective, the Dow Jones Transport Index doing well this year, though, as you can see since the summer, just lost a little bit of altitude, so let's keep an eye on that. I also like chips, though this refers to silicon chips, the Philadelphia Semiconductor Index, 30 stock index in the USA, 30 global semiconductor makers and semiconductor production equipment makers. Silicon chips are everywhere, $600 billion global revenue industry. You can find them in your smartphone, your iPad, your computer, your smart meter, your car, your fridge, you name it, they're there. So it's a really good proxy for economic growth. And also, chip stocks are good proxies for global risk appetite. They are momentum jockey stocks extraordinaire. Love earnings forecast upgrades from analysts, recoil from earnings forecast downgrades. SOX index has ripped up by some 50% from its lows. That would suggest the global economy is okay and supply chains are normalizing. But do note, we're just starting to see that come off a little bit at the top. So again, just be a little bit wary. Maybe things aren't quite as healthy as we'd think. But let's keep a track on that. That is almost saying we're certainly getting some economic growth right now. Could be in the inflation camp. Could still be just about in the Goldilocks camp. Now, different picture. Bond markets. This chart in the last week has changed since I drew it. The yield curve has become less inverted, but it's still inverted. And that is normally seen as the bond market's way of telling you there's a recession coming. So this is a different message altogether. If you think about it, if I lend money to you for 10 years, I will demand a higher coupon and interest rate if I do it for 2 years, because just more things can go wrong in between, whether it's inflation, interest rates, you trying to run off with the money, whatever it happens to be. So I will demand a higher coupon or rate over 10 years than I do for 2. But right now, government bonds in the UK and US, the 10-year is yielding less than the 2-year. Why? That's the market, the bond market pricing in future rate cuts in response to an economic downturn. The bond market has been telling us for over a year there's a recession coming. Been wrong so far. It's not normally wrong terribly often. So this is something that we need to bear in mind, perhaps from the deflation, disinflation camp. Another thing that's not looking very happy are small caps. Now, they're normally very, very plugged into their local economy. They haven't got the breadth of management, haven't got the breadth of staff, product, service, marketing, or what have you, to be too big. So they tend to be plugged into their local market. And as we can see here, the American Russell 2000 is below its peak from 21. The UK FTSE small caps going nowhere fast. They're finding it hard. And the American Bankruptcy Institute is currently statistics saying there'll be more bankruptcies amongst US small caps in the first 6 months of this year than the whole of last. Not normally a good sign. You would want to see small caps performing well to give us a little bit more confidence in the economic outlook. Now, this may be because these are people have been crushed by rates, higher rates. Big corporations have got really, really effective and well-run treasury departments. A lot of them refined very aggressively during 2020, 2021 when rates were low. So they've got low interest rate on debt, and now they're getting interest rates, higher interest rates on their cash. They're getting positive carry. Small caps are unlikely to have been as efficient, as well run. They'll be getting the nasty benefit of the higher interest rates on their debt. So that may be why small caps are finding it tough. But again, monetary policy is designed to hurt. It's designed to slow things down. This again feeds into the slowdown, disinflation, maybe even worst case deflation camp. I've been banging on about debt for the last 20 odd minutes, and this is why. This is total US loans and debt securities outstanding, now 90 trillion US dollars, 3 times GDP. Now, okay, that sounds, it is scary, but I think what's really scary, more pertinently, you can afford that if interest rates are 0, right? Doesn't matter. But what if interest rates are going to 5% or more? Oh, look, your interest bill has just basically doubled in the last year. And it's now running at more or less $1 trillion a year. Now in America, this is a challenge. American taxation income is $5 trillion US dollars a year. 3 trillion gets spent on welfare, 1 trillion on defense, and 1 trillion now on interest. Oh, I haven't mentioned education yet, or anything else for that matter. This is one of the reasons why the bond market has been puking up US treasuries recently, because they can say America's got to refi about half of its government debt in the next 2 years, and B, there's a strong sense that there's more debt coming out as the Biden government continue to spend like a drunken sailor in the run-up to the presidential election of next year with a 6, 7, 8% budget deficit annualized. This is serious. This also tells us that rates possibly can't stay high for longer because the US government can't afford it. It's the same in the UK. The annual interest bill on UK government debt is now £115 billion. Only the NHS gets more as a government department. That's not sustainable either. So central banks just could find themselves boxed in. Need to raise rates to rein in inflation, particularly if oil kicks off again, but can't go too far, or governments are going to be in a really, really big hole, particularly when central banks aren't blindly buying their debt anymore under QE. They're trying to get rid of it under QT. So this is a key pressure point. It may just box in central banks. Maybe governments and central banks take their chance with inflation rather than deflation, because they cannot afford this to go against them and crush their incomes through too much interest on debt. And debt has to keep growing. Look at this chart, look at this trend. You see a tiny dip in the middle, about 2008, 2009. That was the great financial crisis. Tiny dip in debt growth, global economic heart attack. Debt has to keep growing to keep the wheels spinning. Debt has to be kept cheap. If forced to choose, central banks and governments will have to choose inflation or stagflation rather than deflation, because if deflation happens, they can't afford to service this. Oil is a wild card. If I knew where it was going, believe me, I'd tell you. I don't. But what I do know is we still need 102. We're still using 102 million barrels a day, and demand is growing. We've been told not to drill for the stuff, so we haven't. That could be potential. And again, we're still excluding Venezuela, Iran, Russia for geopolitical reasons. Venezuela may be coming back into the fold, but the Biden administration is also still banning new shale exploration and new pipelines. That's not helping supply growth at a time when demand is still going up. So managing this transition to a net zero world, if it indeed is attainable, it's going to be very hard, and that might mean that black stuff like oil is around for a lot longer than we would hope or think or expect. And if it kicks off like it did in the 70s, we have a potentially stagflationary or inflationary situation on our hands. So far, this Middle Eastern conflict is contained. Allies haven't joined in economically, allies haven't joined in militarily. Let's see what happens. But that's what started the 1973 oil embargo against the West. Oil prices spiked, inflation kicked off, and the Iranian Revolution of 79 cut global oil supply, and that made a massive difference as well. So oil is a key wild card. Keep an eye on it because it could be a big game changer. If it comes down, that's good news. If it goes up, that's potentially very tricky indeed. So the American broadcaster Ed Murrow very famously once said, well, if you aren't confused, then you don't understand the situation properly. And I think it's fair to say that financial markets are confused. In conclusion, equity markets are telling us that there's going to be no recession, maybe not even a soft landing, let alone a hard landing, certainly in America, and that we're maybe even going back to the happy promised land of Goldilocks. Economy not too hot, interest rates not too hot or cold, earnings nice and steady, inflation cooling, lovely. Bonds and small caps aren't convinced, they seem frightened of a recession. Commodities could yet be pointing to inflation or even stagflation, particularly if oil kicks off. So I'm going to leave you with one final chart. I've been doing this since 1991 as a fund manager, investment bank sell-side analyst and broker, journalist, and now, thankfully, AJ Bell's investment director. During those 40 years, I've basically seen cheap energy, cheap labor, cheap money, cheap goods. What if that's going to change? Energy could be more expensive, money is now more expensive, labor could be more expensive, and so could goods because of a reversal in globalization. But if what's worked for the last 40 years worked in one environment, surely it won't work for the next 40 if the environment's completely different. I hate saying it's different this time because that normally comes back to bite you on the bottom, but it's something that we really need to think about. And if one chart will help us spot whether we are seeing a real inflection point and a change in the mood music, this might be it. Bloomberg Commodity Index divided by the S&P 500 index. Line down, equities outperform. Line up, commodities outperform. False start last year, but you could argue, if you're certainly a technical analyst, that the commodity index is forming a bottom relative to the equity index. Doesn't necessarily mean commodities are going to tear away. Equities could go down. If equities go sideways and commodities tear away, though, that line will start to go up as well. Maybe, just maybe, after 10 years of not adding capacity here because of environmental pressure, because prices for metals collapsed, because prices for oil collapsed, because metal companies did stupid M&A deals, maybe, just maybe, the realization that we still need oil, unfortunately, we still need metal so we can achieve a cleaner, greener world of EVs and everything else. We still need copper, lithium, and aluminium, and all these different things. At a time when supply has not been added there, maybe, just maybe, we do get a different world of more expensive money, more expensive labor, more expensive goods and services, and just higher inflation. Then maybe real stuff will have its time in the sun again. And that might be doubly the case if, heaven forbid, there is a disinflation or deflationary shock and central banks in a flap go back to cutting rates quickly and QE. Then you would think that people might start to look at real stuff because there isn't a lot of growth in supply and central banks can't print it. Food for thought, at least, if nothing else. So thank you very much for your time. It's much appreciated. And maybe with a little bit of luck, see you at the Investable. Thank you and keep well.
Thank you, Russ. Now, if you have questions for Russ or for any of our speakers, do put them on the feedback form, which, as I said earlier, will pop up at the end of this webinar. On to our next session, looking at what is on the regulatory agenda. Our speaker is Maria Monici, Fund Manager on several of M&G's multi-asset sustainable investment strategies. Maria has been part of the multi-asset fund management team since January 2017, and before joining M&G in 2009, she worked at Barings and UBS Asset Management. With a ridiculously impressive education section on her CV, including successfully completing the University of Cambridge Institute of Sustainability Leadership Programme in Business Sustainability Management. Ladies and gentlemen, you're in for a treat. Maria Monici.
Hello, and thank you for your time today. We're going to look at several items, but in particular, broadly, what is on the regulatory agenda and why should multi-asset investors be aware of this theme going forward. We will start by looking at some of the longer-term risks that are identified today. And this is from a survey that is done by the World Economic Forum. It's called the Global Risk Perception Survey. It's a survey that has been running for several years now. And this is the result for 2023 when we look at the top 10 risks over the next 10 years, so longer term risks. And you can see how there is quite a lot of green boxes on this page because many of the risks that people reached by the survey had identified, which are experts in different fields, including business, finance, and academy. It's very much related to climate. You can see number one is failure to mitigate climate change. Number two, failure to climate change adaptation. So very much at the center of what we should think about for the longer term in terms of risks. And why is it important for investors? Where on the back of this acknowledgement of some of the risks that our society is facing, being linked to climate and in particular to, as we said, climate change and mitigation and adaptation, it shouldn't come as a surprise that when we look at the regulatory environment around climate, that has become very much a global phenomenon. So policies that were initially brought to the fore by, for example, the European Union, which has been an early adopter of some of those policies, are now very much reverberating across the globe. And here you can see in this image some of the regulatory environment and regulation that have been pushed forward in the last few years. And first of all, you can see that it's very broad in regional approach. So you see Europe, but you also see the UK, the US, and Australia. And you also see a focus on different parts for what concern, climate change mitigation, and in particular transition, focusing on hydrogen, on supply chain, on networks, on renewables in particular. Now, there is different types of regulation out there. In particular, I think one that has been very much the focus of markets in the past couple of years has been the IRA, or the Inflation Reduction Act in the US. Because, for example, it's taken a slightly different approach, which is by applying tax credit for companies that were pushing forward the usage of renewables. So the point being that they have all the same focus, which is pushing a more diversified source of energy across countries, and in particular with an eye to mitigate climate change and therefore use renewables more widely. But there has been different approaches in which these goals have been trying to achieve by the different regulations. And trying to understand some of the differentiation here can be quite interesting for investors today in interpreting what we are seeing in different sectors and in different regions across markets. But nonetheless, the big theme is that with climate change remaining one of the key risks for the long term, regulation has continued to be very present and will continue to affect the way we look at our investments and the way we have to think about them on a forward-looking basis. And there are two elements about, regulatory shifts around climate change that are quite often coming to the fore. The first one is how much would it cost? How expensive is it going to be to do this transition? And net zero is what is considered as, the ultimate transition, achieving the ultimate goal. And here we have a very interesting example that is focused on the UK, which was presented as part of the Office for Budget Responsibility Fiscal Risk Report, sourcing from some data that was put together by the Climate Change Committee, which was asked and tasked by the government to represent some scenarios for net zero. And without going into the details of what is a very complex assessment of the net cost, and also based on different possible scenarios. So here you can see, for example, a balanced pathway towards net zero. What is very interesting about the chart that you can see on the left-hand side are really two things. One is that the cost of the transition is very front-end loaded. So you can see the black line really peaking quite early on into this process for what concern the investment cost of going into the transition. But also what you can see, the second very important element, is what you see on the right-hand side of the chart, which is this black line really coming down quite significantly and eventually bringing benefits from a cost perspective to the overall economy. So in here, we're looking at the net cost by sector for the overall economy, and not just the public sector. And further to this, there was an additional note on the fiscal risk report this year for 2023, which really focused on, thinking about the cost of transition in the context of being still reliant on global gas prices as an important source of energy for our economy. And what the fiscal report highlighted was that, continuing to be dependent to gas, and in particular, given the variability and volatility of global gas prices that we have seen, would also be very expensive, especially fiscally, so for the state, over the coming years. And so this will also be a consideration that has to be taken into account when we think about transition, which entails, having a more diversified source of energy overall. So the elements that we want to bring to the fore with this slide is that, the fact that the energy transition might be very expensive is very much dependent on scenarios, on the time horizon, and what are the other sources of energies that a country or an economy is using. The second element that is very much common when we talk about transition, and that has been very much at the center of debates recently, especially given the focus on inflation, as inflation has become a much more prevalent feature of our economies in the past few years, it's greenflation. So would the transition bring on additional costs, and would they bring to sustain inflation over the longer term? This is a study that has been done by Goldman Sachs Investment Research, and it's focusing specifically on Europe, and it brings together electrification cost curve. So at what level of dollar per barrel the different electrification strategy amount to. And if you can see the red line here, this is an equivalent of about $80 per barrel. And you can see that with that type of price level, many strategies from solar, from onshore, energy efficiency, offshore solar and grids and onshore grids in Europe are actually deflationary. So they come at a lesser cost than what we're currently paying today, or will be paying at $80 per barrel equivalent with the current setup of energy sources. So I think, again, this is a very interesting observation, because yes, there will be some pressure on cost as this capacity is being built, and we have seen some of these, in the past few years. Obviously, inflation has come to the fore for many different reasons, and not only because of the transition, but there is an element of higher demand for certain goods, for certain materials, for certain skilled labor as well, to be able to deploy these type of strategies, which on the short term might define an increase in cost. But given the advancement of the technology on these different energy sources, we would expect, actually, as this chart is showing, over the long term, over the entire period of the transition, some of these changes to become deflationary. Why is this important? Obviously, we're looking at a very long-term period, probably longer than any investors today is thinking about. So 10 years is indeed a long term. But as we travel through this period, there is some important elements that are more short-term in nature, and they will affect our holdings and our portfolio construction in the shorter term, that we ought to be aware. And those are the four that I have highlighted here. So in first instance, supportive regulation. So although the goal is quite far ahead, supportive regulation is something that we continue to see, and that can affect performance and margins and profits of different sectors in different geographies in different ways. Some elements of the latest ones, for example, are here. We mentioned the Inflation Reduction Act, the European Green Deal, but also from a more finance perspective, SFDR, and soon in the UK, SDR coming to play. So in a certain way, companies that are more aware of what this regulation means for them, and are in some cases better placed to reap the benefits of those, are certainly something that can benefit from. Energy independence is the other element. The importance of energy security really came to the fore in the past few years. The need of diversifying the mix of energy that a country rely on, and we see a very important role to be played here by companies that invest in renewable infrastructure, being solar, onshore wind, and we have companies that we believe are very well positioned to continue the build of capacity for additional renewable energy. Technology advancements is a very important element that has really driven, the cost curve of these energy techniques down significantly in the past 10 years. And we continue to see technology as being a very important driver for improvements going forward, and also companies that continue to invest in R&D in this space to benefit from it. And finally is demographics. Demographics are really an important element when we look at the broader society, the increase of healthcare needs for aging population, new ways of working. We have experienced that post-pandemics, a very different way to approach work, which can support diversity and inclusion. And in this case, again, we find companies that are, working to support some of these dynamics more closely. So all of these drivers are extremely important, not only in the long term, which is where we see more of the changes from a climate change mitigation and adaptation perspective, but also in the short term and when managing multi-asset portfolios. So if we come back to today's, what are we observing? From a macro development standpoint, we really are today in a very different place from where we were at the beginning of the year, when expectations were for quite weak growth and for inflation to come down potentially a little bit faster than expected. What we've experienced throughout 2023, and you can see this here, on these two tables as we move towards the right-hand side, is an improvement on expectation for growth, which actually came out relatively solid, although we still have indicators, specifically leading and sentiment indicators, that are pointing towards some slowing. And from an inflation perspective, inflation that has come down but has remained probably a little bit stickier than people expected. So in a way, the risk of recession has been pushed forward into 2024, and you can see that at this stage, there is still relatively benign but sluggish growth perspective for 2024 GDP. And for what concerns CPI estimates, you can see again this continuous sluggishness and slow coming of inflation. What does it mean for investors? That there is very much still an environment where investors are in need of further data and a longer trending set of data to be able to see with more clarity where are we today in terms of the macro environment. So are we low inflation or high inflation? Are we low growth or high growth? In the meantime, what we're seeing is that investors' beliefs have continued to shift quite significantly in the past few months. You can see in this chart a measure of the number of Bloomberg story on keywords. Inflation featuring extremely importantly last year, now slowly started to come down on the green line. Recession also being a key element that was, markets were concerned about last year, and today almost, going back to a much more normalized level. But what is picking up, and although in a different scale, it's quite markedly, is the concept of higher for longer. So I believe that, the level of rates that we're seeing today are really here to stay much longer than initially expected. And we see it is very much reflected on the correlations between equities and bonds. You can see here, a very different phase that we've entered from what we've experienced the past 10 years, which in an environment of very low rates, often close or below zero, have brought about negative correlation across assets, while in the most recent past, these increasing rates have brought about positive correlation across equities and bonds, which are obviously a new and challenging environment for multi-asset investors. What we can observe is, if you look at March this year, during the US regional banking crisis, you have this slight red negative correlation element, which make us more confident in the diversification properties of fixed income, and in particular sovereign bonds going forward, especially given the higher level of yields that we have today. So we haven't encountered yet a real risk of market. Even the March phase this year was very much contained to a specific sector. As soon we move in a more broad risk-off environment, there is potentially today opportunities for some of the sovereign bonds to diversify portfolios. Overall, when we look at market, three key elements that we assess: the asset price behavior, macro developments, and investors' beliefs. Today, when we look at the different asset classes, we're relatively neutral to underweight in equities, where we observe neutral valuations but underpinned by earnings that are relatively solid and might decline in the future, especially if there is ongoing pressure from elevated discount rates and higher cost of capital. However, there is many differences within equities, both from a regional and sectoral standpoint, and so we use these differentials to create more diversified portfolios. Within fixed income, we're relatively neutral, with sovereign bonds in developed markets offering now increased compensation for the potential diversification, although the challenge remains of having very elevated cash rates on the short end of the curves. We continue to like emerging market local currency bonds, which were really at the forefront of this tightening in monetary policy we've observed in the last 2 years, while we find credit slightly less attractive in the current environment with limited yield pickup versus cash. And finally, cash and other assets were relatively overweight. Cash offers interesting real yields, and also it's uncorrelated to other asset classes, and finally provides us with some firepower to be able to intervene should markets provide us with opportunities. But we also like some selected infrastructure, in particular investments that provide good prospects for stable income and exposure to real assets, in particular with leverage on green energy transition. All of these views are applied across the sustainable multi-asset range. This is a range of 3 funds: sustainable multi-asset, cautious, balanced, and growth. These funds have a key characteristic of having a dual objective, financial aim as well as sustainability aim. You can see how the financial aim is very much around volatility and volatility management in this space, and we also provide some typical equity allocation and a performance comparator. These sustainability aims are strong and measurable. In particular, we look at the MSCI ESG rating, the carbon intensity of the portfolio, and the exposure to positive impact investments, or investment that provide solutions for sustainability over the long term. You can also see the funds having some external risk and sustainability ratings. Overall, 3 distinguishing elements and characteristics of these funds are the ability to combine strategic and tactical asset allocations, so some of the themes that we've explored just now. These funds are invested in direct holdings, and these give us a really strong in-depth financial and sustainability analysis, together with the ability to be active owners. And finally, is about transparency, obviously in regard of financial, but also or in regard of sustainability objectives, which we report on a fund level and a single holding level, and that are enclosed within our ESG and impact report, which we publish on a yearly basis. So overall, my message will be climate change mitigation and adaptation. There are challenges for the long term, but change doesn't happen altogether, and we are already seeing some important short-term changes and trends that all investors should be aware, and that we can take a more direct exposure on as part of our sustainable movement. Thank you very much for listening.
Thank you, Maria. Now, our next speaker is Dan Ryan, Portfolio Manager and Senior Manager Selection Analyst from Fidelity International. Dan joined the Fidelity team as a graduate after what must have been a pretty storming summer internship. He focuses on building portfolios, which include investments as diverse as infrastructure and aircraft leasing. And sticking with the theme, he is exploring the pros and cons of alternative investments, what to seek out and what to avoid. Dan Ryan, ladies and gentlemen.
Thank you. I'm Dan. I work in the Fidelity multi-asset team, where I'm responsible for our alternatives investment research. There are a couple of things I want to discuss today, but mainly I have 2 objectives. The first is to explain what we think alternative investments are and what benefits they bring to a multi-asset portfolio. And second, I want to give you a framework that I use when assessing an alternative investment for the first time. I genuinely think I have the best job in multi-asset because the universe of investments that I analyze is so broad and diverse. But what brings all of these together is that as alternative investments, the drivers of return are distinct from what drive traditional stock and bond market investments. In other words, these are different sources of return for the risk that you're taking. So, to point out some examples, renewable energy, a key driver of return there is the speed of the wind or the amount of solar light that a solar farm receives. Those are clearly not the same as what drive equity and credit markets. I've also put litigation financing up here. What drives returns there is whether lawyers can correctly predict the outcome of a particular case so that you can fund a case with an outcome that's going to settle or succeed. Event-driven strategies. These are strategies that are arbitraging corporate events, so clearly distinct again from equity or credit cycles. I've also put music royalties there. I think certain types of music royalties might be counted as alternative investments. But in particular, I'm talking about investments in classic rock or pop catalogues, where the number of listeners is very steady, and as a result, the royalty income is highly visible and predictable over time. there's also a limited number of these assets. They are irreplicable. By definition, you can't today produce a brand new catalogue of 1970s songs. And that again contributes to the visibility of the income stream into which you're investing. On this chart, we show the expected risk and return over 10 years in sterling terms from various asset classes. This is in sterling. The takeaway here is that liquid alternatives can enhance the risk-adjusted returns of a multi-asset portfolio. But what exactly do we mean here? This slide counts as a bit of a cheat sheet to answer that first learning objective. What are the characteristics that alternatives might bring to a multi-asset portfolio? So on the left, I've put some different asset classes or types, themes or sectors within alternatives. And along the top, we have different qualities that our portfolio managers will be seeking when allocating to that particular asset class of alternative. The takeaway here, diversification always. Once again, it goes back to my original point. These should have distinct risk drivers from traditional stock and bond investments. As I've included a lot of real assets and infrastructure here, these are operating portfolios with high cash yields, which are again reliable and predictable. And so they often enhance the yield of a multi-asset portfolio when included. So too, as real assets, and often with contracts that are indexed to inflation, they can offer anti-inflationary or inflation resilience to a multi-asset portfolio. This is quite key to our portfolio managers today. But it's worth addressing some potential critiques of what I just showed you. So you might be sitting there thinking, Dan, you showed me a number of illiquid investments and claimed that they were diversifying. But in reality, I have a daily dealing fund. And if I want to allocate to infrastructure or real estate, I need to buy an equity wrapper, a listed fund, a listed investment trust, for example. And if I do that, I have near-term sensitivity to the equity market on which that fund is listed. This is a fair point. The price we pay for liquidity is short-term correlation to the equity market on which a listed fund is listed. But I would make 2 points back. First, you can and should hedge some of that equity risk, and that's what we do within multi-asset portfolios. Number two, the data shows that if you can see through that short-term noise and hold these assets for a multi-year holding period, 3 to 5 years, the returns from a listed alternative vehicle are commensurate with a private alternative vehicle. For example, a listed real estate investment trust and a private property fund. This isn't surprising. We're harvesting the same risk premium here. We're allocating to long-term assets, and it makes sense to hold these over the long term. The second potential critique might be, Dan, your last slide had a number of clearly low-risk investments in things like core infrastructure, where we can see that there might be a low correlation to risk assets. But your first slide had things like leveraged buyout funds and venture capital. These are clearly higher risk investments. So where's the diversification there? At that point, I think this is less a criticism and more a feature. It's a good thing that alternative investments occupy the full range from low risk to high risk. And so that a portfolio manager wanting to change the beta or risk profile of their multi-asset fund can allocate to different alternatives to achieve that outcome. What I mean here is the mindset for allocating to alternatives is a bit different from allocating to an equity or fixed income fund. When allocating to an equity fund, I'm trying to outperform a benchmark. But when allocating to an alternative investment, I'm trying to bring a certain characteristic or quality to the portfolio. Further critique might say, if you compare the dividend yield on some of these alternative investments in the listed space to credit indices such as investment grade bonds, we see a similar yield and a similar risk, which raises the question, what precisely is the alternative investment bringing to the portfolio? And I would make 2 points in response there also. Number one, it is a bit unfair to compare the dividend yield on a listed alternative to investment grade bonds, because the dividend yield on an alternative investment is only half the story. We're really allocating for yield and growth. For example, I'm not allocating to a real estate investment trust simply for a 6% yield. I'm allocating for the dividend yield and the outlook for rental growth, which might be 5 or 6% on top. So too, to go back to music royalties, I'm investing there for a 6 or 7% dividend yield and a prospect of growth, growing income. For example, I might have seen Spotify and YouTube subscriptions going up in price and seeing higher revenues there. I might see broad market growth in the music industry, maybe of mid-single digits a year. I might have seen favorable court rulings in the United States around copyrights and intellectual property and see that again as a tailwind to further growth. Or I might have invested in a classic catalogue of songs and now see good opportunity for those songs to be used in modern films or television adverts and further increase the value of my investment, growing above and beyond the dividend yield. Second, a number of these alternatives have inflation indexed contracts. For example, investing in renewable energy infrastructure, about half your income there is indexed to inflation through a government subsidy regime. And that means every spring in the UK, typically, I'd expect those subsidies to increase by the last 12 months RPI. For the other half of the income earned through selling electricity, over time, I'd probably expect an indirect relationship between energy prices and inflation. That's not the same for investing in the credit indices on that chart on the left. There, the coupon is the same over time, but with certain types of alternative investment, I'd be expecting that income to rise over time and protect the value of my investment from inflation. I try to make that point on the right-hand side, where the two coloured lines, orange and yellow, show the net asset values of two UK infrastructure investment companies, with blue showing RPI over time. And we can see a broad relationship. For the second part of this presentation, I wanted to offer you another cheat sheet, which shows some of the things I look for when evaluating an alternative investment for the first time. This is my job in one slide, and I've summarized it in 3 steps. Number one, it's worth kicking the tires, trying to work out what exactly makes a particular investment opportunity alternative. There are a lot of ostensible alternatives out there. Certain types of private equity are simply disguising equity risk that you probably already have in a multi-asset portfolio, or certain types of alternative income strategies are really just hiding credit risks, which again, you probably have in your portfolio already. Number two, fundamentals. This is a broad category, but what I'm trying to do here is assess the defenses that I have, things that will ensure that I can capture that alternative risk premium over time. So, for example, I might be looking for monopoly, regulated networks and systems, government concessions. Those are things that might protect my income. They make it predictable and visible over time. Alternatively, there might be high barriers to entry. For example, a strategy that requires lots of lawyers or a team of pharmaceutical experts. That's hard for a competitor to set up and challenge a particular strategy. And then third, there might be high internal diversification. For example, some private credit strategies. If there is good internal diversification in that portfolio, I know that one loan going wrong won't affect the overall returns. And then finally, management quality. I want to make 3 points here. Number one, this space is filled with people who claim to have proprietary origination networks, and we should be a little bit skeptical. People who claim to be able to buy assets for 90p when their competitors must spend £1, that's very rarely a durable source of return. This space is filled with skilled managers who compete with each other, and it's just not realistic. It doesn't have the ring of truth to it that one manager would consistently buy things more cheaply than all their highly skilled competitors. Number two, at any point in time, there is always someone making money, maybe for a number of years, in ways that are completely not repeatable. And this might be because of all the levers they have in front of them. They're pulling something which relies on a short-term dependency, a near-term cyclical tailwind, some correlation to a macro factor, which, when it changes, will cause those returns to fall off a cliff. You must be very attentive to this type of risk. And then third, this space is filled with very good storytellers. A good storyteller, combined with a very complex investment strategy and a plausible track record, can be very tempting. And it's important to have a framework in place to assess the investment opportunity and ensure that it stands up to scrutiny. Over the next few slides, I go into these stages in more detail. But having told you to be wary of storytellers, I wanted to tell you a story myself and then give you an example of how I use this framework in real life. One of the first alternative investments was at the beginning of the 19th century, when the country of Poyais sold bonds and convertible securities and land rights, predominantly in Britain. They raised hundreds of millions of pounds in today's money. Now, the chap who was largely responsible for selling these bonds of the country of Poyais in the early 1820s was called Gregor MacGregor. Gregor MacGregor came to London and Glasgow with hundreds of pages in a prospectus extolling the future tax revenues, the future projected earnings of the country of Poyais, supported by its lush agricultural land, great mines and natural resources, ports and an export network, and this is a quote, rivers filled with globules of gold. Well, if you haven't already worked out the punchline, the country of Poyais does not exist. But the interesting point here is that on 3 occasions, the authorities tried to take him to court. And on each occasion, people who he had defrauded came to his defense. They said, no, we believe the country of Poyais exists. They had convinced themselves so fully in the investment thesis that they weren't allowing themselves to see any new information that might change that original thesis. Now look, this framework is not really intended to screen 19th century financial frauds. But what it is meant to do is screen out some of the window dressing that even modern managers might do with their funds. We're thinking how to screen out some of the tendency towards optimism, some of the ways in which investment managers today might flatter their future cash receipts and make an investment look quite a bit better than it really is. Let me take a moment to tell you how that happens in the renewable energy space and some of the things that I've really seen over the past years. I told you at the beginning that renewable energy earns about half its revenue by selling electricity. And so these investment managers need to forecast future cash flows from future sales of electricity. If I tell you that there are only a handful of forecasters of power prices in London, some give you a very low forecast, some in the middle, and 1 or 2 very high forecasts, I'll let you try and work out how many renewable energy funds use the very lowest forecast. I can think of perhaps 1. Many will do an average of all 3, blend different low, high, and medium forecasts, and say they're agnostic, but that increases their forecast revenues. And some will simply use the highest forecaster, and in so doing, call it a leading forecaster. But that's the most optimistic cash flow of all. And if you're not correcting for that in your investment thesis when comparing different funds, then you're really comparing apples and oranges and allowing that window dressing to affect your thesis. Let me give you a second example. Around about 2019 and 2020, but continuing even just as recently as the last few weeks, a number of these funds came out and announced that although originally they thought their wind farms or their solar farms would last 25 years, they actually now reckon that they'll last 30, 35 years. You can see that has a big difference on returns. If you can project cash flows for 25 years or 35 years, you're going to want the 35-year cash flow stream. I was looking at some of the language that funds have used very recently, and it's pretty active. Words like rolling out asset life extensions, completing asset life extensions. It might give you the impression that there's some capex, a maintenance project. Maybe the turbines have been reinforced, cleaned, or parts replaced. But if you look under the bonnet, in many or perhaps most cases, I suspect there hasn't been any capex at all. Rather, an engineer might have gone out, looked at the wind farm or solar farm and said, well, I realize the manufacturer said 25 years, but I really think that will last for 35 years, and signed off on a report. Sometimes that engineer will be employed directly by the investment manager. What's more, sometimes you might dig into these claims and find that the land, which is leased from a farmer on which the wind farm or solar farm is built, that land might not be leased for the new extended life of the asset. So the farmer might want their land back in 25 years, which means it's not perhaps fair to presume 35 years of cash flow from that asset. There are many similar examples of window dressing and tendencies towards optimism. We can see this sometimes in refinancing or operations and maintenance contracts. Inflation recently has been a source of this. Different investment funds will use different sources to inflate their cash flows over time. Some OBR, some single forecasters, sometimes a blend of forecasters or a market implied rate. Sometimes new sources of revenue that were previously immaterial will be found and brought into the cash flow mix. And it's worth testing these and asking whether the investment manager is really being sensible by predicting new forms of revenue. Want to go back to the three-step process. It's always worth asking, is this investment opportunity genuinely diversifying an alternative? Is its source of return different for the risk I'm taking? And then, is that cash flow, that return, reliable? And second, third, is it repeatable? And therefore, worth putting into a multi-asset portfolio. Thank you very much.
Thank you, Dan. Now, the wonderful thing about these events is the opportunity for discussion and disagreement. To that end, after our last session extolling the virtues of diversification, this session asks, is it worth the price? At the helm, Andrea Pioch, Portfolio Manager at Legal and General Investment Management. Sitting in the multi-asset funds team, Andrea has been with L&G since 2014. He's also an ESG advocate. He holds GARP Sustainability and Climate Risk Certificate. Ladies and gentlemen, Andrea Pioch.
Hi, my name is Andrea Pioch, and I like to think of myself as a diversification disciple because I've been looking after diversified multi-asset strategies for over 15 years now, and managing our flagship legal and general multi-index range for over a decade. At the same time, I've been lecturing on diversification and asset allocation at the University of London, and I really lost count of the number of times that I mentioned to either my clients or my students that diversification is still the only free lunch of investing. But the more I've been managing money, the more I realized that even diversification has a cost. And with inflation rampant all around us, even my beloved diversification and its cost has been rising recently. And that cost is called regret. Now, it's all about the regret of missing out on the best, which when it comes to human emotions, as we're very complicated creatures, that regret is dominating the relief of avoiding the worst. It's all about the famous FOMO, that fear of missing out, because we as humans, we love to have options. And what we really hate is when these options are taken away from us. But it's interesting that the things that we don't do seem to be so much more painful than the things that we actually follow through with. Now, why is that? The answer here is our psychological immune system. Because our brains don't want us to be overwhelmed with regret 24/7. So they conspire against us. What do? Well, they actually, as soon as we do something embarrassing, they start to rationalize and then turn us humans into rationalizing machines. How does it work? We do something, we probably regret it, and the brain immediately kicks in and starts looking for silver linings. And the thought pops in saying, well, it was probably for the best. Now, when we don't do something, when there is no actual experience to rationalize away, the research shows that the brain actually has much more trouble searching for the silver linings. And that's because the situation is all too hypothetical. It's all too abstract. And our brains prefer to focus on things that did happen or the experiences that did take place. Now, what it means in practice is that they're very helpful in helping us get over things that we did, but they do leave us hanging in regret over the things that we didn't do. So today we'll revisit one of the key regrets for diversified investors, and it's all about regretting or missing out on the best performing assets. Because often when we talk about diversification, yes, we often focus on avoiding concentrated positions in the worst performing investments. But unfortunately, the same is true in terms of us not having these concentrated positions in the best performing assets. So how can we approach it? Well, the first step we can do is to go back in time, back to 2016. And if you were back in 2016 and you ask someone to provide you with a 5-year projections for different asset classes, it will probably show you a chart like this one. What it will show are all the major asset classes plotted against their prospective risk on the horizontal axis and prospective returns on the vertical axis. Now, this chart wouldn't raise any eyebrows because we recognize that virtually all assets are associated with a certain degree of risk, and those with higher volatility are expected to reward us with higher returns. So for example, here we perceive US volatilities as more risky, hence we expect a higher return relative to, for example, emerging market debt in local currency. So far, so good. Now, this is how it started. It was 2016, the 5 years have passed, and this is how it's going. It's 2021, and as usual, the reality turned out to be very different from these average estimated outcomes. Now, when it comes to equities, probably not that surprising, because we know that equities with their average volatility of 15%, what that means is that in any year, there is 1 in 3 chance that these equity returns will be either 15% above or 15% below that estimated average. And depending on how the events actually turn out over that 5-year period, some assets will do better, other assets will do worse. And in this case, US equities were the star performer, well ahead other asset classes, and in particular, that emerging market debt in local currency would actually manage to lose money over that period. Now, when it comes to our psychology, when we look at this chart after the fact, our brain confuses us a little bit more because it convinces us that, well, that was knowable in advance. Often it would even convince us that it was inevitable. And that hindsight bias is one of the most commonly documented flaws in human reasoning. Now, when we translate it into the problem of regret and diversification, we all know that in any given period, there will always be an asset class that will do better than a diversified strategy. And yet we might find ourselves trapped in that perpetual cycle of regret, of negative feelings, and even feeling tempted to reallocate back to asset classes that recently already did well. So how can we help ourselves? Well, the one thing that I find really helpful is to take a step back, gain a little bit of a bird's eye view or a long-term perspective on the matter. So when we look at the last decade, the period between 2010 and 2020, that period belonged to two huge powerhouses, US equities and Pharrell Williams. Why Pharrell Williams? Because his song Happy was the one that was most played in the UK over that 10-year period. Now, in the same way as these most popular songs change decade after decade, the same is true for leadership in equity markets. So what you can see here is that, yes, in last decade, the US equities were well ahead the equally weighted average of all these equity indices. However, since 1950s, when Markowitz started talking about his free lunch of investing and diversification, it was only one other decade in 1990s that was the case, that US was above that equally weighted average. In all other decades, it was actually below. What we can also see is that very often those big winners turn into big losers. So in 2000s, Australia and Canada were the best performing markets. And unfortunately, 10 years later, they end up right at the bottom alongside Italy and UK. But there's something going on here as well around that dominance of US over the last 10 years. Because there's a number of side effects, or you could say unintended consequences, that today introduce very new risks for equity index investors. The first one has to do with the rising weight of US itself in the global index. And when you were back in 2010, US would be still less than a half of your global equity portfolio at around 45% weight. Now, in 2020, it's nearly 70%. What that means is that there is a country in your global equity index portfolio whose weight is more than double all other countries combined. And when you look at that pie chart from 2010 and the pie chart from 2020, these are very different portfolios. And someone who invested in that initial portfolio could be surprised just how different their allocation is today. Now, some of it is a reflection of the strength of the US economy, and it's true. US is still the largest economy in the world. But when you break down the world by its market cap in equity indices and its GDP, it still can't be, economy itself and its size still cannot justify the dominance of the US that we've seen more recently. The other problem that causes many headaches for equity index investors today is how much of company-specific risk they actually carry. Because if you added the 5 largest constituents of the US equity index back in 2010, they would add up to just under 10%. If you repeat that exercise today, that's over 25%. So more than a quarter of US equity index is now allocating to just 5 companies. And as that company-specific risk more than doubled, it of course will have an impact on performance. So what you can do is look how much of US equity returns can actually be explained by individual companies. So in 2020, 2/3 of your equity returns can be attributed to the mega cap tech names. But unfortunately, the same is true on the way down. And in 2020, again, 2022, again, 2/3 of your equity losses this time, again, can be traced back to the same 7 companies with the new addition of Tesla. Unfortunately, 2023 is no different. If anything, that concentration is even more extreme when you look at the returns to the end of September. 85% of those returns are only due to what happened with companies like Apple, Microsoft, or Amazon. Now, when you look at these statistics, I do wonder whether this is the level of diversification that index investors were looking for when they, for example, moved away from active strategies back to the indices. Because that move often is driven by a desire to actually lower your company-specific risk and gain exposure to a broad market theme. But unfortunately, that company-specific risk is coming back into some of those index strategies. And of course, that doesn't come without risks. And to quantify that risk, we looked at how those largest companies in the US perform versus the broad market over long term. So we looked at it since 1970s. And essentially, every year, we looked at the performance of the largest stocks versus the rest of the US market. We did it on a 1-year rolling basis. Now, it's a very noisy series. Sometimes these largest companies will outperform, other times they will underperform. But when you look at the far right of this chart, which is that recent history, it's interesting to see that this level of outperformance that we experienced over the last, say, 5 years, yes, it is very material, but we've been there before. There were periods in the past where that outperformance was of similar magnitude. And unfortunately, if you were to learn anything from that long-term history, is that what often happens is that these largest companies then significantly underperform the rest of the market. Now, when you look at those extreme events and focus on the outperformance first, then on average, the outperformance is in the magnitude of 8.4%. When you look at those extreme episodes of underperformance, is actually larger, of minus 9.4%. And over the full history, it would be a negative 60 basis points. Now, that full history result probably wouldn't surprise some of you, especially those that research the small cap premium and all the academic papers that have been published about the idea that over long term, small cap stocks outperform the large cap stocks, and that's what this result is showing. Now, the interesting question now is, how can we think of these new risks in the context of consumer duty? Now, when you read through the consumer duty, the regulator is always very careful not to be too prescriptive about a specific solution that a client should take. But the one thing that they do stress is the importance or the responsibility of us as the industry to make sure that the consumers understand the risks that they take and also accept these risks. And given the huge shift that we've observed in the global equity indices over the last 10 years, we do need to ask ourselves whether these consumers appreciate the change that has occurred in their equity portfolios and are still willing to accept that rising level of stock-specific risk, particularly within the US indices. Now, if they're not willing to take on that much of company-specific risk, what can they do? Now, in the equity space, they could go back to active management, but unfortunately, that could lead to higher fees. The other alternative would be to still use index strategies, but don't just follow the global equity index benchmark. Use regional indices to then spread your risk across key geographical regions. For example, invest 1/3 in North America, 1/3 in Europe, and 1/3 in Asia Pacific and emerging markets. Now, when you translate that same challenge into a multi-asset space, It's something that we've been discussing with advisors for quite a while, because these concentration risks in, say, a 60-40 portfolio really came to the forefront in 2022. Now, in the same way as you can tilt away from the global equity index into a more balanced, regionally weighted index strategy, you could also tilt away from the 60-40 portfolio to a more diversified mix. And you don't have to go all the way towards that new diversified strategy. You can actually blend your 60-40 or more concentrated portfolio with that new element. And you can do it by adding 25%, 50%, or 75%. And this is the sort of analysis that we've been doing for advisors for the last few months, as they want to see what the trade-offs are across different aspects of what could matter to their clients. Now, the first thing that you can look at is what does it mean for your stock level concentration, which often is the first trigger to explore that idea of blending multi-asset funds a bit further. And you see that you can bring it down from 11.4% all the way to 5.3 or 5.4%, depending on the blend. You can also check what contributes, or what is the largest contributor to your risk. Because in a 60-40 portfolio, while it's still a portfolio of equities, global equities, and global bonds, 2/3 of your risk is still sitting with US equities. Now, in a diversified strategy, you can bring it down to just over 20% and allow other assets to have a more meaningful contribution to your overall portfolio risk. The other thing you can look at is your regional exposure. Again, 60-40 portfolio, very much concentrated in the US, both in the equity and bond space. And as you add to diversification, other regions, again, start to contribute more to your returns and your risk. And finally, we also did some analysis on what that could mean for your prospective returns. But as we know, and we learned from history, we cannot really think of prospective returns as just point estimates, because there's always some uncertainty around it. So we always complement it with a 90% confidence interval to also show some of the downside and upside risks around those averages. And we also added a probability of beating a particular target return. In this case, CPI plus 2%, but we can model it for different target return levels. Now, the example that you see here is done for a mid-risk allocation blended with a multi-index 5, but we did the same analysis for our low-risk multi-index funds like multi-index 3, our high-risk multi-index funds like multi-index 7, but also our income strategies, our ESG multi-index range, and our models, whether it's models that we build for growth, for income, or for ESG clients. And we can apply this consistent framework because whether it's a fund or a model, everything that we manage will follow the same core philosophy or the same core set of investment beliefs. And we summarize it by our 5 pillars of multi-asset investing, which recognize the importance of diversification, the one that you see here right in the middle, the importance of cost effectiveness, because unfortunately, when it comes to investing, fees are still the only guarantee and will inevitably be a headwind to your long-term returns. The importance of dynamic asset allocation. So yes, we use primarily index funds to populate our asset allocation, but we know that it's really important to be able to respond to changes in market conditions by adjusting that asset allocation over time. The importance of suitability. So whether it's a model or a fund, we'll be targeting a specific risk profile to help advisors with their ongoing suitability requirements. And finally, the importance of active engagement, where we pledge to never abstain. And when we see that the company is not doing enough in addressing some of those environmental, social, or governance challenges ahead, we will challenge them. We'll use our size and scale of LGIM to make sure we can secure a better future for our investors. Now, sticking true to these investment beliefs, as we did since we launched multi-index funds 10 years ago in August 2013, when you're clear about your investment beliefs and about your philosophy upfront, when you even write it down, it's much easier then to deal with the regret risk afterwards in more volatile markets. What also helped us is, rather than just focusing on the one asset class that did the best and then beat ourselves up for not having allocated more to it, a useful exercise is also to check which asset class did worst and how would you feel if you had a concentrated position in this one relative to your diversified portfolio. Because regardless of how much effort, time, and resources we spend on building forward-looking projections for risks and returns, there is always an element that's left there that will impact future asset performance in a more random way. There is that randomness component that we can never really quantify away or model away. And the diversified strategy essentially aims to minimize the impact of that randomness on your future client outcomes. So if you do all this, if you're clear about your investment beliefs upfront, then, and you document it well, then that should help you deal with the regret risk afterwards, and should also help you avoiding the temptation of following the herd into investments that already did well in the past. And that in turn should make that diversification lunch taste a little bit sweeter in the future. Thank you very much.
Thank you, Andre. Now it is time to take a very quick coffee break. We'll see you back in 5 minutes. welcome back, everyone. Do get comfortable. Now, we've seen this year that the benign environment investors have rather got used to over the past 15 years and no more. What are the risks and challenges that the new economic environment presents? To discuss this, a man with 19 years investment management experience, James Clemster, fund manager and deputy head of multi-asset at Line Trust.
Right, hello everybody, and thank you for joining us in this webinar. The topic for discussion today is investing in the new old world and why we think this is a brave new world for multi-asset investing. Lots to cover. We'll go through lots of different topic areas, and obviously if you do have any questions, please do feel free to get in touch with us, and we'll happily go through those questions with you. Just some information at the start there, and then we'll get into the slides. So I think the main two features of the landscape that we're into at the moment are shown here on the left and on the right of this slide, a sort of confluence of two pretty major forces impacting the UK investment market, UK advice market, and the client experience at the moment. A changing investment environment on the left, and we'll talk at some length about what's going on in investment markets and why we believe the pain experienced by many investors last year in particular represents a reset and a move into a more positive era for investment markets generally. And then on the right hand side, a changing regulatory environment, most notably consumer duty and the impact that has on how we all need to consider client needs. And that's why they're very much at the center of this slide here, focus of these two forces coming together, the confluence of those forces really in terms of the impact on client needs and what we can do to look after clients in this environment. So let's get into what's changed in the investment environment, what's the landscape, and what are the features that we can see presently. What we're showing here is the mid target of the Fed funds rate, the base rate, for want of a better word, in the US. Could have shown the UK, could have shown pretty much any major market really. They've all sort of followed a similar path to this. And what you can see on the left-hand side, so the right-hand side, most notably as you're looking at it, is the rapid increase in interest rates over the last year or so, coming from a very low base, of course. And what we're trying to show, I suppose, is a number of things. The longer term context of that move, the fact that in that green line increasing up to around about 5%, we're actually only just really in line with the long-term average since 1971. And so as much as it's been a very steep and aggressive hiking cycle, as central banks realized they were behind the curve when it came to interest rates and inflation, and they ran to catch up and perhaps overtake it and really sort of seize the initiative. We saw a very steep increase in interest rates, but only actually really back to long-term averages. Arguably, looking at this slide, really, I think the point is the period between the global financial crisis, which we've denoted as GFC there, and then the sort of COVID-19 period. That very low interest rate period is arguably the unusual era. And so when we refer to investing in the new old world, what we're really referring to, I suppose, is looking back to a period pre the financial crisis, pre that rock bottom, incredibly low interest rate and inflationary environment, and looking at the sort of the 80s and the 90s and even the early noughties as much more sort of normal period for investment. And then, of course, thinking about that, bearing that in mind, thinking about what sort of investment approaches were successful in that period there, and whether they are appropriate for the era that we are going into. And conversely, that shaded area that we show there between global financial crisis and COVID-19, why we believe that's a poor blueprint for the era that we are going into. I suppose if you think about that environment, very low interest rates, as I've said already, very low inflation. Inflation was so low that actually it allowed interest rates to be kept at those rock bottom levels. Governments and central banks almost couldn't create any sort of meaningful level of inflation. And as we'll come to see later on, we believe that we're in a different era now, where inflation is more likely to be a feature of the environment we're in, more likely to be a bit more prevalent. And on that basis, it's unlikely we'll see interest rates fall back down to those extraordinarily low levels between the financial crisis and COVID-19. And that's why we think there are certain implications for investors from here. So look at some of the characteristics of that unusual period. What we're showing on this chart here is the relationship between rolling 3-year performance of the US market and rolling 3-year performance of the world ex-US market. And we're showing rolling 3 years just to take away some of the noise that you'd get in shorter term data. And you can see on the left-hand side of the chart in the 70s and the 80s, clear periods where the MSCI US, the US stock market, has outperformed the brown colored line there, and periods where the brown colored line or the sandy colored line outperforms the green. So there's an ebb and a flow, periods where the US beats the rest of the world and periods where the rest of the world beats the US. There's certainly no one dominant force in that chart there. As you move between the TMT and global financial crisis, you can see a sort of a big pull away of the world ex-US versus the US, but then that reverts, and then in that period from global financial crisis onwards, it really is a very sort of one-way street. You can see very clearly that the green line stays above the gold or the brown colored line on a very consistent basis between 2008 and 2020, even into 2022 and today, despite that sort of pullback in growthy stocks that we saw last year. It's still actually very much a sort of dominant force on that chart there. And so we would suggest that's the unusual period. It's not happened previously in history. It really normally you see a sort of an ebb and a flow between these different markets rather than expect to see one of them dominating the others. So clearly during the shaded period there, if you had a one-dimensional approach to investing, if you had a very sort of singular approach, very heavily weighted in the US, for example, at the sort of expense of diversification, at the expense of your global exposure, you'd have looked pretty clever. And so I suppose the suggestion we're making as we go forward from here in a different era is, don't presume that strategies that work well in the shaded area will necessarily work as well in the area we're going into. Likewise, comparing value and growth, two sort of predominant investment styles that I'm sure everyone's familiar with. Looking back over the same period, again with rolling 3 years of data to take out some of the noise, you can see in the 70s into the 90s there, periods where value, that gold line, outperforms growth, the sort of the grey line, and periods where growth, the grey line, outperforms value. And very clearly between, in that sort of TMT, the bubble era, you can see a big outperformance of growth, which then comes back. But again, you have that sort of interplay, that yin and yang, if you like, between one doing well and another doing well. Post-financial crisis, again, same story as we saw in the last slide, a sort of dominance, a predominance, if you like, of growth over value. There's no sort of no ebb and flow, no give and take there. Again, if you had a very sort of singular portfolio construction approach, which was heavily invested in growth stocks, that era with very sort of cheap and loose monetary policy would have helped you and achieved some very sort of dramatic results. It got even more catalyzed, if you like, as COVID hit, and those stay-at-home stocks outperformed even further. And you can see on the right-hand side of that chart that gapping out between value and growth, which has since sort of pinched back in again. But again, that unusual period between the financial crisis and COVID, we believe, is unlikely to be an appropriate blueprint for where we're going from here. Another feature of the post-financial crisis period was low volatility. Again, the amount of looseness from monetary policy and a concerted sort of global fiscal policy kept volatility very low, despite having a couple of very volatile periods bookending that sequence we can see there. The bit in the middle was actually a fairly sort of gentle investment period. On the right-hand side, you can see slightly more elevated volatility levels, higher, not high, and we think that's a more sort of likely characteristic of the era we're going into, less compared to that very low volatility period we've come from. So what's going on? What's the main driver of this? Well, we think one of the most fundamental features of the environment we're in at the moment is globalization and a trend to see, I think, what we refer to as slowbalization, a sort of pulling back from the sort of the doctrine of shipping stuff around the world, having a very sort of permissive approach to that, which has created a lot of competition around the world, and competition sort of results in deflationary forces essentially. What this graph shows, and clearly if you went back through history, you could draw it all the way back to the Roman times, I suppose. You can see that there are periods where globalization increases and periods where you see a sort of stepping back from globalization. The period from the 80s to the sort of 2010s, I suppose, was sort of kick-started by Thatcher and Reagan and their sort of very permissive and sort of capitalist doctrine, if you like, an era where generally you saw liberalization of policies that encouraged globalization and enabled sort of huge amounts of disinflationary forces to be exported around the world as production moved to the lowest sort of marginal cost zones for any sort of given item. But you've seen since the sort of financial crisis period-ish, 2010s onwards, you've seen a sort of panacea there in terms of your globalization, and starting to see perhaps a little bit of a step back from that, whether it be because of company experiences during COVID and during the supply chain issues that we've seen there, whether it be due to populism in terms of politics, a bit of regionalization, and even, of course, now higher geopolitical risks. All of these different sort of themes are starting to weigh on globalization slightly, and we're not sort of suggesting we move to an era where globalization ceases to be an important feature, but we are seeing a sort of stepping back, a reduction in that competitiveness, and an environment where competition diminishes, you would expect to see some more inflation. So it's a different era, we believe, that we're going into. So what's the new strategy to deal with that? On the left-hand side, we're sort of highlighting what we believe to be the new regime, the major sort of themes that we're going to see in the investment worlds from here. I've mentioned most of these already. Less synchronized global economies, where governments and central banks focus on monetary and fiscal policy to suit their own inflationary regimes rather than almost sort of having half an eye on a bigger picture. You're likely to see greater disparity between economic performance. And all of these features, we believe, speak to the investment approach on the right-hand side. So a more multipolar world. So diversification makes a lot more sense. Debt will be more expensive. Liquidity will likely be less. We do need to bear in mind, though, across the top on the right-hand side there, that economic growth will return. We're in the sort of doldrums from the cyclical perspective, and news flow is, relatively negative when it comes to the global sort of economic backdrop. But, we've got to bear in mind that, we will move into a sort of expansionary phase at some point, but we're likely to have higher base rates, high volatility, and all of these points really speak to us to have more active management in portfolios. So what we do when we think about our process, we don't want to change our process. We believe the process is appropriate, but what we always want to do is to look at our inputs into our process and make sure that they are, as good as they can be. Our decisions, our choices, our thought processes within the bigger process are, as good as they can be. So, the left-hand side there are our, broad tenets of our investment philosophy, what we believe, and, how we look to invest. And what we have done, bearing in mind the new regime we're going into, is to ensure that our strategic asset allocation, our sort of starting point, is fit for the next 10 years rather than being a product of the previous era, which, as we've said already, we don't believe to be a good blueprint for the next 10 years. So, we've worked with a new provider, Hyman Robertson, to give us inputs and data into our SAA process. We've got a more flexible model now, more nuanced, and one that we believe will be better positioned for the era we're going into. What it doesn't reflect is a sort of a wholesale change in terms of risk profiles. Clearly, if a client sits in one risk basket before, they should remain, or we should provide a sort of suitable investment solution, following that change. And so if you look at the sort of overarching large asset class characteristics, you can see in terms of, between left and right, before and after. Not dramatic changes in terms of the allocation to asset classes like fixed income or equity, with equity being sort of the main driver of real returns over the long run, in our opinion, and fixed income and cash being very effective diversifiers over the long run. So you're not seeing a dramatic change in the sort of the major categories in that graph there. But what you are seeing, crucially, is that greater nuance, that greater subtlety and flexibility, which is denoted by the detail, those increased number of categories within the large categories, particularly within fixed income. There you can see sort of greater degree of modeling capability in fixed income, which is exactly what we want to have at our disposal in the era we're going into. So in terms of regulatory environment, we won't spend long on this. You've spent plenty of time talking about consumer duty, where we at Liontrust in sort of the investment team focus on in multi-asset side is the products and services, price and value, consumer understanding, and consumer support. So if we try and sort of embrace the consumer understanding side of things and come back to strategic asset allocations, this is an example of that. You can see in this example here, we're trying to sort of denote risk profiles as mountain ranges. So you can have lower risk mountains, you have higher risk mountains, but crucially they all have a degree of risk. So you can envisage those as lower risk SAAs, strategic asset allocations, higher risk strategic asset allocations, all aiming for the summit, all aiming for the pinnacle. But clearly it's a more difficult journey to get to the higher summit than it is to get to the lower summit. So you've different risk profiles, different sort of levels of ability as a mountaineer, if you like, different sort of tastes for adventure, and so you choose your mountain based on your particular risk profile. But that's not the end of the story. So while all managers in each of those risk categories are all aiming for the summit, they may well take different routes to get there. So whether it be Snowdon on the left or Everest on the right, there's more than one way to scale those particular mountains. And so if you're thinking about managers even in a single risk category, it's reasonable to assume that, or hope that, managers take different routes. If everyone takes the same route, if you find a blockage on the way, if you find a bit of a hard to traverse patch, if every manager's on the same path, they're all going to experience the same problem. So, with the summit there, we're all aiming to get there at roughly the same time, but the journey we take to get there may be different. And when you think about that in terms of, I suppose, performance, think about it in terms of your vertical elevation on the way to the summit from the baseline. It might be if you take the Snowdon example, if you start from the north, it looks like a longer track, so it might take you longer to get there, but it might have fewer sort of hard climbing bits, meaning that actually, while the shorter route from the south might get, immediately better progress, but then you slow up because you're having to sort of scale a more difficult pass. And so that's, an analogy to start to bring SAAs alive to investors. You have your risk profile, but then you have different journeys to the risk profile, the summit, which people progress up and down at different rates. So, just speaks to why, it's important to message what you're doing as you go about it on the way to the summit. So just to sort of wrap up, how we at Liontrust believe that total multi-asset approach that we have really helps, not only from the investment piece, but also from the consumer duty, particularly in terms of the understanding and ongoing support side of things, as well as the value for money, of course. And our philosophy is a sort of all-encompassing approach to multi-asset investing, which obviously sort of has our values at the top, but then value for money, transparency, a long-term partnership approach, and supporting not only yourselves but also clients on the journey to investment results, but most importantly, suitability. We believe in active management, and even in our dynamic passive solutions, whether they be funds or portfolios, we believe in actively managing the allocations of those solutions, but then investing through passive vehicles. We believe in choice, so suitability, different risk profiles, some funds targeting outcomes, some funds targeting more returns orientated solutions or portfolios as well, of course. Support and understanding, value for money, transparency. And so in terms of active management, why we believe in it, we believe in added value, we believe in independence, the importance of being able to have a wide array of managers to choose from, but crucially, we believe in patience we don't believe that you can sort of get results over the short term. We want to have a process that encourages achieving good results over the long run. And of course, you need experience in order to have the conviction, but also, of course, the belief, but at the same time, the desire to always improve a process or improve the inputs into a process to get that combination that you really want when you're thinking about a long-term investment solution. In terms of the choice, target risk, we have Explorer, which is more returns orientated, and as I've said already, a combination of both active and passive solutions. And then from an understanding and a support perspective, that sort of partnership approach, the openness comes in terms of dedicated support, comes in terms of access, reporting, and using language that we believe clients will understand rather than relying on advisors to translate it for us. Saves advisor time in that sense, educational content, and also risk profilers and tools as well to help on that journey. So if we come right back to the start, think about what we had on the left-hand side, the changing investment environment, combined with that changing regulatory environment. The client needs at the heart of it, we believe that total multi-asset will help clients and yourselves meet those outcomes, meet suitability requirements and consumer duty responsibilities. So with that, I'd thank you very much for your attention. And if you do have any further questions, please do get in touch with us or with your Lion Trust support. Thank you.
Thank you, James. Now on to the catchily titled recession or no recession. That is the question. There are plenty of flashing warning signs, but those signs have been flashing on and off for quite a while. To discuss whether we are in hot water or not, Keith Balmer, Portfolio Manager, Multi-Asset Columbia Threadneedle Investments. Welcome, Keith.
Hello, my name is Keith Balmer, and the title of the presentation today is Recession or No Recession? That is the question. And so hopefully, if I've given myself enough time, we are actually going to be able to answer that question at the end if we're going to be going into recession or not. But the idea behind this presentation is to try and talk about exactly what is a presentation, what do they look like, what happens during recessions, particularly to asset class prices, what you should be doing in portfolios. And so hopefully, if I've left myself enough time, we get to answer the question as to whether we are indeed going to be going into recession. So if you I've just taken a quote from Paul Samuelson, so famous economist back from the 1960s. Stock markets predicted 9 of the past 5 recessions. So effectively what he's trying to say is that we shouldn't be looking at the stock market as a guideline as to whether recessions are actually going to be happening or have happened. There are clearly big reasons why stock markets sell off, and it's not just because of recessions. So we have to look at something else, but how do we define it? First, the starting point should be exactly what is a recession? If you are in England, which I assume everyone is, or in Britain at least, then ours is very simple in terms of definition. We have 2 consecutive negative quarters for GDP growth, and if we have that, then automatically we have recession. Now there's nice and simple, so we can understand exactly when these happen. Very easy to understand, but we do get to see situations where, say for example, Germany at the start of this year, they managed to have a situation where they had minus 0.1% on one quarter, minus 0.1% growth. So 2 negative quarters of growth, which meant to say officially they had a recession. But over that time, the equity markets went up, employment actually got better. So really didn't feel like a recession, and probably actually wasn't a recession. But technically, that will go down as a recession. In the US, they have a slightly different way of doing it. They have a committee, the Business Cycle Dating Committee of the NBR, the National Bureau of Economic Research, and they sit together and they determine whether and when the recession has actually happened, when it starts and when it ends. And their definition is a significant decline in economic activity across the economy, lasting more than a few months. So it's not just about GDP, it's about multiple different factors, including employment, including stock market performance, including productivity, including sales, etc. So lots of different factors, and they determine what it is. And for the purpose of this presentation, we're going to use the American definition of American recessions. So that's the recession. So what do they look like? Well, I've taken all the recessions in the US post World War II, and if you want to know what an average recession looks like, well, it typically lasts about 10 months, but can extend as long as, or has extended as long as 18 months, and has been short as 2 months. That was the recession that we've just been through the pandemic. In terms of frequency, they happen almost every 5 years. The most frequent, i.e. the one that happened the earliest post the previous recession, was actually only 2 years. The longest was 11 years later. Once again, that was the one with the pandemic, so post-global financial crisis. In terms of GDP, you typically get a drop of about 2.2% and an increase in unemployment of around about 3.9%. So they're not nice things. Effectively, recessions, they're very painful for the man in the street, for the general economy. So we don't like them, but it's just one of the natures of the economic cycle that we go through. If I go back to 1854, then actually what you find is recessions were much longer in nature and actually lasted an awful lot longer. So we have actually elongated the cycle in more recent times, but that's what an average recession looks like. And now if I detail all the recessions from top to bottom, I've ordered them by length of recessions. As you can see, the global financial crisis is at the top. That was the one that lasted 18 months, and the pandemic is the one at the bottom that lasted 2 months. But if you look, basically a mild recession is going to last somewhere around about 6 to 8 months. An average poor recession, or averagely tough recession, lasting somewhere around about 10, 11 months, and the longer term ones, so the deeper recessions last a little bit more than 2.5 years, so 15 months to 18 months. Peak unemployment, that's different from what I showed before in terms of the stat, but you can see peak unemployment can reach some quite large numbers, but typically through a recession, your peak unemployment is going to be somewhere around about 6 to 8%. So if we think about roughly where we are in terms of numbers, between 3 and 4% at the moment, if we are going to go into recession, you would expect another few percent to go on top of that. So what are the different types of recessions and what happens? Well, there's 3 main types of recessions out there. Boom and bust, this is the one that Gordon Brown famously said that he'd got rid of, and clearly hadn't, but this is the most common. This is the one that we normally see. So during the boom period, economies expand quite nicely. They do very well, growth rate increases, everyone's doing very well, and unfortunately inflation is a natural consequence of that. And because of that inflation coming through, then you get central bankers, the party poopers coming in to cool things down. They raise interest rates, move money into restrictive territory, and as a cause of that, they generally make a policy mistake, and growth gets killed so much that we go into recession. Then they go and reduce those interest rates into more flexible monetary policy, and as a consequence, we then go back to another boom cycle, another expansionary cycle. So that's the most typical one that we see. But there's 2 others. There's balance sheet recession. So within a balance sheet recession, that's when you have a drop-off in growth that's caused by a shift in consumer behavior or business behavior, typically around concerns about high debt. So global financial crisis is a pretty good one around that. So effectively, you get through this period where it's easy to borrow money, and it becomes incredibly difficult to borrow money, and people, instead of spending money, save money and pay down their debt. So if you think of the global financial crisis through 2007, really easy to get a mortgage in the first part, 2007, 2006. And then in 2009, 2008, incredibly difficult to get a mortgage, and so therefore the amount of money that was in circulation gets sucked out, and hence the economy falls down. That's not just in terms of mortgages; that's also in terms of businesses being able to access the capital markets. And then you've got the third option, which is a supply side shock, and we should know all about this because we've been through one pretty recently. So that's when a global event effectively causes the recession, so it causes trouble with supply chains. So whether that's a war, natural disaster, or, as we are far too familiar with in recent times, a pandemic, so public health crisis. That means to say supply chains shut down, causing imbalances, which means to say that you get a drop off in growth. And so once again, that should wash through, but effectively you've got to wait for that event to pass before supply chains can start up again. So that's what the sort of general recessions are. What shapes do you get? Well, don't bother trying to say that word. It's not a word, it's just the different shapes that you can get. So you have V-shaped recoveries. Now, these are the ones that you want. If you're going to have recession, this is the one that you want to have. This is where GDP drops off, so growth drops off for any of the three reasons that you saw before, but then quickly recovers, and so therefore you get the smallest impact on GDP, the quickest recovery, so therefore that's what you really want to have. The example I've got given here is the 1953 US recession. So you had the Korean War. After that, you had concerns about inflation. The Fed stepped in, increased interest rates, but actually inflation never really came through that strong. So they quickly reversed that decision. Interest rates came back down, and off the economy went again. So V-shape's what you want. If you're going to have a recession, that's what you want to have. U-shaped isn't quite as good as a V-shape, so you have a drop-off in economic growth, and unfortunately you don't recover particularly quickly. So therefore you have a period of flat GDP. So growth, so it doesn't really expand, doesn't really go anywhere, doesn't get worse, but doesn't get better. So it takes a little while before you get that recovery phase coming through. Example of that 1973 US recession, where growth didn't recover until 3 years later, so it took a long time to come back. W-shape, once again, so typically I've shown in my schematic quite a nice two double V shape, but actually typically the second V is actually more of a U. So you have a recession for whatever reason, it looks as if it's going to be a V-shaped recovery. Everyone becomes happier, they start spending money, capex starts going through, people start businesses again, and then unfortunately for whatever reason the economy turns and falls over, and that's why you generally get a U shape on the next part, on the next leg, because people are much less reluctant to go out there, spend money, put capex plans in place, and so therefore you generally get a bit of economic malaise for a little while before getting that recovery. So 1980 was a pretty good one in terms of that. So you had the 1980, you had the V shape, but then unfortunately 81 it dropped back down again, lasted a year before going back up. So working your way down the list of recessions, you don't want to have an L shape, is very bad. You don't want to have the L shape. So this is where you have the drop off in growth, and then you just have anemic recovery. So whatever reason there was behind that drop off in growth, it just means to say that economies have been really set back a long time. It takes a long time before that expansionary period comes through. Really good example of that was Greece during the 2008 global financial crisis. So we all had a recession through that time. But Greece, for the next decade, their growth rate was actually beneath 2% on an annual basis, frequently negative, and just never managed to get going. So if you remember a post-global financial crisis and Eurozone debt crisis, Greece was clearly the poster child for that particular period, and really tough for them. And so you really don't want to have that L-shaped recovery. K-shaped, well, this is quite an interesting one. This is where you get a two-speed recovery. So it's a combination of a V shape with an L shape. Pandemic is pretty good on this one. So you get the drop off in growth. That was in this particular case caused by the pandemic shutdown, global shutdown. But if you remember, during that shutdown, what you had was that everyone buying a bike, electric bike to sit in their front room, so they could do that through Peloton. Everyone's doing working from home. Everyone's buying laptops, trying to work out how to do that. So the technology side of the economy did really well very quickly. So recovered very sharply. Whereas if you're in the services industry, whether that's travel, leisure, hospitality, restaurants, etc., that took an awful lot longer because of those lockdowns, extended lockdowns, and concerns about pandemic. So they recovered an awful lot slower. So you had a two-stage recovery for the economy. So those different types. So what actually happens during assets during recessions? Well, I've unashamedly borrowed this slide from PIMCO. They did it better than I can, so might as well take all of their data. What PIMCO show is that they've split the recovery and the expansionary and contractionary phase into two different halves. So for the contractionary phase, so the recession, it's in halves, and then the expansionary phase, they've put it into thirds. So if we just take the recessionary part, I'm going to start on the right-hand side. So going into that recession, so expansion final third. So we're just coming to the end of the expansionary period. What actually happens in terms of asset prices? Well, commodities still doing incredibly well, equities still making a bit of money, but you're starting to see a little bit of trouble through the fixed income market. So high yield starting to lose money, but actually government bonds losing more money. And once again, that should be relatively well known for everyone at the moment or familiar. because that's exactly what's happening at the moment in our markets. And that's why I think we're probably in the final third before we pop into recession. So when you go into recession, what do you want to be holding? Well, you want to be holding bonds, and that's it, just high quality fixed income. It's the only thing that makes money. Commodities lose money, but only a little bit of money. Equities and high yield having the worst time. So during that first half of the recession, really you don't want to be holding your risky assets. And then you've got to be brave. So halfway through that recession, you want to switch your portfolio completely. Now, government bonds, they still do okay. In fact, they do better than the first half of that recession, because if you think about what's happening, if you're going through the second half of the recession, it means to say central bankers are now cutting interest rates. They're trying to loosen monetary policy, trying to stimulate the economy, which is clearly going to be good for government bonds. But actually, if you're coming out of that into the recovery phase, into that expansionary period, hopefully, then equities have bottomed out. And actually you get some decent, really good gains from equities. High yield as well does well, not quite as much as it loses in the first half. And commodities actually is where you don't want to be in that sort of second half of the recession. Moving into the expansionary phase, equities, clearly that's the best place to be. Then you go into high yield, then commodities, and this is where you want to basically be moved out of bonds because there's better returns elsewhere. You're not doing badly in bonds, you're just not doing as well as other asset classes. And that continues all the way through. And commodities, as you can see, has that nice movement all the way through until effectively that final third where commodities has its peak. So effectively, what you want to do with your portfolios is going into recession, sell out of all equities, or at least be underweight equities. Through that first half recession, only be in high quality government bonds, and then second half recession, be brave, sell down a bit of those bonds in favour of equities, because that's where you're going to get the best returns. So when do you actually invest in equities? Well, once again, if you're working on averages, which is a dangerous way of working, but if you want to go on averages, then the equity markets tend to bottom on average 8 months after the recession starts. However, that is somewhere between 33 months and 1 month. So there's quite a lot of dispersion on that one. Now this is now taking not just post World War II, it's including all the data that I can possibly get. So that 33 months is actually the Great Depression. So maybe not a good benchmarker, but the number of months between the market bottom and the end of the recession, 5 months. So on average, if you think it takes 8 months to get down to the bottom and then 5 months up, it's not exactly halfway through, it's about 2/3 of the way through. Unfortunately, this information is completely useless to everyone because you don't know exactly when the start of the recession was or when the end of the recession was until after the event. So effectively, you've got to understand, if you have a shallow recession, it's probably towards the front end of that. If you have a deep recession, then you have to wait a little bit longer. So where are we now? If we look at the consensus of probabilities by economists through Bloomberg, then this is where everyone thinks we are. So this is the last 2 years worth of, or the best part of 2 years worth of data. And you can see all through 2022 up to the end of the year, those 3 lines all kept getting steeper. That meant to say the economists were forecasting a greater and greater likelihood of a recession in the next 12 months. The purple one is the UK, so we got up to 90%. So far, that's now dropped back down again. So economists, I think they've made a bit of a mistake there, but we've still got a few months to run. Europe, once again, that's the silver line. That got through to 80%. If you remember concerns about natural gas prices due to the Russia-Ukraine war, we're going to get a cold winter. That was going to potentially have rolling blackouts. That would have clearly been a recession. The US was much lower down. The economy was doing much better. But actually, the US economy is the only one in terms of probabilities that hasn't really dropped back down. More recently, it's dropped back down. This is when everyone's been moving from hard landing to soft landing, but it's still around about 55%. So a bit of a coin toss as far as economists are concerned. UK is still slightly higher, around about 60%, and Europe about 50%. So economists don't really know. If I was to look at the world around me, then it's quite interesting because in our camp, so in our multi-asset team at Columbia Threadneedle, we've got people in the soft landing camp, we've got people in the hard landing camp, of which I'm a paid up member, and we've got people who are sitting on the fence. So it really could go lots of different ways. But a soft landing, what does that mean? It means say inflation comes down to 2 to 2.5%. Unemployment doesn't rise up significantly from where it is, and growth continues to eke along okay. Now, the problem with being in the hard landing camp is that you've got to go through the soft landing in order to get to your hard landing. And that's where I am. And my problem is that I think that you've got just a policy mistake being made by by central bankers that will hold rates higher for too long to make sure that inflation comes down. And unfortunately, that contractory territory that we're in will stay there too long, and they'll stave off growth for far too long, and unfortunately we'll drop into recession. Now, the good news is, and this is where I think soft and hard landing members both agree, is that if we do go into recession, it will be fairly light. So therefore, it will be shallow. It won't take too long to get back out the other side. So if we have a soft landing, happy days, it's going to be good for equities. It will be also relatively good for fixed income, because to get to that soft landing, you're going to have interest rate cuts to move away from tight monetary policy into neutral. So therefore, that's going to be good for high quality fixed income. If we have the recession, it's going to be bad for equities, as we saw going into that recession, but good on the way out. And for fixed income, high quality fixed income, it's going to be much better because you're going to have those cuts basically front loaded. So you're going to have to go from being in fiscal tight conditions all the way through neutral into loose monetary conditions to make sure that you get the easing coming through, so you get the expansionary phase after that recession. So all in all, I think asset prices looking from here are going to be okay. You take two different paths, but in 18 months' time, I think we'll be through the worst of it in any case, if we have a soft landing or we have a hard landing. So hopefully that's been useful. Conclusion is recessions are very hard to predict. No two recessions are the same. Are we heading for a recession? My view is probably late 2023, early 2024, but there's no bubbles out there, so therefore even if there is one, it's going to be shallow, but there's a good chance we could avoid one in any case. And if you are going to have that, then in your portfolios you should be overweighting high quality fixed income at the moment and underweighting equities. I've left myself about 30 seconds just to talk about the products. So the products that we run, if you are interested, then please do get in contact with us. We run two ranges of multi-asset portfolios, the universal ranges. So one is traditional, the other one is sustainable. So if your clients have sustainability needs, then we have that for you. They go from defensive through to adventurous. So if you know your DTs, then on a risk rated scale, that's a 3, 4, 5, 6, 7. If you like your de factos, it's a 3, 4, 5, 6, 8. We also have an income fund. The best way to describe these and why you should be interested in them, not least because their performance is pretty much outperforming everyone out there since inception, but it's active management at a passive price point. So the OCF is capped at 29 basis points for universal, 39 basis points for traditional sustainable universal, but we do active management top to bottom. So that is active management in terms of strategic asset allocation, tactical asset allocation, but also we use the best of Columbia Threadneedle to bring in that stock selection. So you get all of that for that passive price point. So the only thing about these things, these funds that is passive, is the price point. There's nothing passive in the portfolios, and hopefully that will be useful for your clients as we navigate the next economic cycle. At that point, I'm going to say thank you very much for listening, and say please do contact us if you have any questions.
Now for our penultimate speaker, David Jane, fund manager at Premier Miton. Before he joined the company in 2014, he founded Darwin Investment Managers, and along the way he's worked with M&G, AXA Investment Management and Newton Investment Management. Today he's considering why a natural income approach to financial planning and retirement is essential.
Hello, I'm going to be giving you some very compelling reasons as to why you should be using natural income for your post-retirement clients. But firstly, let's talk about how many of those clients there really are. Obviously, as a consequence of pension freedoms, the fact that nobody has a company-sponsored pension scheme anymore, and so on and so forth, a huge number of potential savers have moved into the IFA industry. These savers are now moving through into retirement age, and you can see that they've got, on average, quite a material sum of money to invest. The industry has been very much focused on the pre-retirement phase, PEPs, ISAs and SIPs, but really we need to change the way we look at the post-retirement clients going forward. The reason for this is fundamentally a unit encashment strategy is a very dangerous strategy for post-retirement clients. We did a little modelling at Premier Miton, and I've done an awful lot more than that is shown here. And what we can see is that there's a huge risk with pound cost ravaging in post-retirement clients who are using a unit encashment strategy. Essentially, if your clients experience a drawdown in the early years of post-retirement, it can make an absolutely huge difference to their outcomes in the long run. What we're seeing here is we've modeled exactly the same investment returns over 30 years, but essentially we've reversed the result of those returns. We've reversed the order of those returns, showing an early years drawdown and then the average returns, or a latter years drawdown. And this is the difference it makes to how long their capital lasts. It makes an absolutely catastrophic difference. You know, you'll drop from 30 years to 18 odd years with such a drawdown in the early years post-retirement. Now, why is that? In a sense, it's self-evident why it is. If you're using a unit encashment strategy, you're essentially selling much more of your investment in those early years at lower prices. If you get good returns in the early years, obviously it can extend the life of that capital for a long period of time because you sell much less units in the falls. But why would you take such a risk? Why would you expose clients to what's potentially, you know, a foreseeable harm in retirement by using a unit encashment strategy? And I was looking at the FCA survey on post-retirement that they issued recently. They're supposed to be giving the results in the next few months. And one of the questions was clearly, have you had to change client expectations as a result of investment losses in retirement? I.e., if you're using a unit encashment strategy with a total return investment strategy, quite possibly many clients have had to reduce their income expectations in retirement as a consequence of recent poor market returns. The FCA are clearly onto this. There's another issue, you know, as far as I'm concerned, regarding the regulatory aspects of investment strategies in retirement, and it's much more straightforward than that. You know, we've seen, you know, over the last decade or so, a really massive improvement in our industry where, you know, clients have come into IFAs, they've said, look, you know, I've got this amount of capital, I want to save this much a year. And we've risk profiled them and we've given them risk profiled investment strategies. That's clearly, you know, an absolutely appropriate approach to pre-retirement, people who are building their capital, they have a risk tolerance. In retirement, you've got an income need. It's a very different need, and therefore very different investment strategies are appropriate for those kind of clients. And in my view, you know, when faced with a complex issue, look for you know, the most straightforward answer to it. Why would you take a post-retirement client and say, look, we're going to give you a total return strategy like you've always had, and then give them their money back as and when they desire it, when you could simply give them a straightforward solution to that, which is an income strategy, give them what they came in to ask for. And that's surely the least risk approach to this. But of course, there's a very good reason, you know, and we're not going to deny this, as to why income strategies haven't been popular in the last 30 years. You know, you've seen versions of this slide many times in the past. This is the correlation of equities and bonds over long periods of time. We've used the S&P and the US Treasury for simplicity and data availability here, but it would work with every market. And the versions of this slide that you've no doubt seen over the years typically start around the year 2000. They will be looking and saying, look, isn't it brilliant? I can construct you a 60-40 portfolio of equities and bonds, and when the equities go down, the bonds will go up, the red period of the slide, and therefore we can immediately construct a portfolio that's effective and efficient over time. Well, the problem with that is it simply isn't true. And if you look over long periods of time, equities and bonds are naturally correlated. And this is something we've been saying since 2020, that we were back in a period of normality and your 60-40 wouldn't work. And clearly that's proven the case. There's a very good reason for this. You know, we've all studied our investment textbooks these days, and we all know that, you know, the US Treasury bond is the risk-free rate upon which the price of all other assets are determined. And therefore, it's obviously going to be the case that equities and bonds over time should be positively correlated. but they weren't, and they weren't for an extended period of time. That extended period of time where equities and bonds were negatively correlated was for a particular specific moment in time. And that particular specific moment in time, the last 10 or 20 years, was also a period where income strategies, value strategies underperformed. Why was that the case? Well, it was the case because you were in a long and extended period of low inflation, low interest rates, and latterly QE. That has now changed, and it's evidently changed, and I'll demonstrate why. You know, it's often a useful process. Instead of trying to prove your case, try to disprove it. Now, the long and low period of inflation, why was it people said that occurred? And there are lots of reasons that are posited as to why we had this long and low period of inflation and low interest rates. Some I think are more valid than others, but you can choose for yourself. One was, you know, the rise of China and globalization generally. That clearly is a deflationary impact. It impacted wages in the Western world. It reduced the price of goods and services in the Western world. Well, if you think that we're still in a period of globalization, you haven't been reading the papers. Globalization really sort of came to an end about 10 years ago and has been in reverse since. It's become much more political lately, but you could see it as much as 10 years ago that globalization was beginning to reverse. And clearly, you know, recent geopolitical events support the idea that we're deglobalizing. There's talk of onshoring, nearshoring, there's ever more sanctions on ever more nations. People are getting ever more protective. So you can't use the globalization argument as a reason why inflation is going to come rattling back down to that exceptionally low period of the last 20 years. Another is obviously resource constraints. You know, we've had a decade or so of very low investment in natural resources, oil, copper, whatever it is, it's in short supply. And that supply constraint is not reversing. You know, the period of ultra low inflation and interest rates coincided with a period of very cheap energy, very cheap natural resources after a period of heavy investment in that industry. That no longer works as an argument for low inflation going forward. The final one I would put, which is arguably two, is, you know, what I call the genius central banker argument. A lot of people have made the argument that because of Volcker's incredibly hawkish policy back in the 80s and 90s, that drove inflation out the system. You may or may not believe that. In a sense, it doesn't matter because it no longer applies. Self-evidently, we've printed, you know, 100% of the money supply in the last, you know, 2 or 3 years. Central bankers are not running tight monetary policy. They're absolutely more concerned about financial market stability these days than they are about inflation. And arguably, you know, the monetary side of this needs a bit of inflation. We've got too much debt being issued, and, you know, governments are clearly being incredibly profligate with future generations' money. And the best way of dealing with that is have inflation running a little bit hot so it drives down the real value of the debt. So you can no longer have the genius central banker argument. You can no longer have the austerity argument as to why you've got low inflation. Evidently, neither of those apply anymore. So we're into a period now of sustainably higher inflation. What I would say to that actually is that there's another important point here. This isn't necessarily a bad thing. You know, we were told to guide, you know, after the global financial crisis when rates came down to like 1%, 2%, 3%, we were all encouraged to guide clients to expect sort of low to mid single digit returns over time. And you know, arguably we did rather better than that. But of course, in a period where nominal interest rates and inflation are running in the mid single digits, which is normal, I hasten to add. We mustn't think that this is an abnormal period of relatively high inflation. We're actually in what, if you look over long-term financial history, in interest rates at 4, 5, 6 is a very normal scenario and one that we should become used to. But if we've got those kind of returns coming from our bond portfolios and higher nominal returns, equities are a nominal asset at the end of the day from our equity portfolios, we can expect much higher investment returns going forward. But what you will also expect in that higher inflation environment is the nature of investment returns to be somewhat different. Firstly, they're going to be more volatile. Secondly, the order of returns, you know, in a more inflationary environment, materials, energy, income as a strategy, value as a strategy typically do much better than growth as a general strategy. So the reason, you know, it's given to me, oh, we don't use income strategies in retirement because they underperform, is no longer the case. Income strategies will outperform in the current investment environment and that which we expect over the next 10 years. Now, the other pushback I get all the time on income strategies in retirement is, well, firstly, they underperform. We've addressed that. Secondly, that they don't provide a consistent and repeatable income. I've put 3 lines on this slide here. I've put UK consumer price inflation, which is the steady sort of pale greeny bluey colour line in the middle there. And you can see that essentially a consumer in retirement, what does he actually want? He wants an income stream that grows in line with inflation. So he wants that line there. But of course, equity dividends have in recent years been relatively volatile. I would add here actually, and it's something that you should bear in mind, that the equity dividends consistently over time are much less volatile than equity capital values. And that's another very compelling reason to use income, because your income is going to be less volatile than your capital value. And if you're relying on unit encashment, you know, if you're relying on the most volatile stream of returns, much better to rely on the income stream. And of course, bond income is incredibly consistent over time. But of course, the problem here is dividends from income branded funds are not consistent and repeatable. Most funds that are producing income over time or brand themselves income fund, multi-asset income, equity income, the manager is not managing the income. And the reason he's not managing it is because he's incentivized by the 1 and 3 performance numbers. And because income as a style or strategy has underperformed for a period of time, they're mostly running total return strategies and are not consistent, are not conscious whatsoever of the income stream that their fund is producing. And so the pushback I get from advisors all the time, I understand I should use income strategies in retirement, but I can't rely on the income from them. And that's because the fund managers are not managing the income. There are 1 or 2 fund managers who do manage the income, me being one of them, otherwise I wouldn't be presenting to you here today. And you can see in the orange line there, the income on a rolling 12-month basis from our cautious monthly income fund over time. And, you know, I endeavour to grow that over time ahead of inflation, and you can see that it's done that over time. Another way of displaying that is, you know, essentially we pay out a fixed monthly payment each month and then a bumper one because of unit trust accounting rules in the month of June over time. And again, you can see even in that very difficult period in 2020 when equity dividends were being very aggressively cut, we never had to touch the monthly payment. That was paid out every month reliably, and a very, very small decline, I think it was 1 and a bit % in the overall income payment for the year as a whole. And so, you know, in a year where there was no inflation, that's not a bad outcome. And then subsequent to that, again, we've been growing it comfortably ahead of inflation, despite the acceleration in inflation over recent years. And that's the objective. And really, you know, this is not rocket science. You just have to sit down and say, my primary objective on this fund is to grow the income in line with inflation over time. Now, the final pushback I always get from advisors on, you know, that sounds great, you know, income as the output, not the input. That's what we're looking for our post-retirement clients, but you're going to be sacrificing total return to achieve that. Absolutely, that doesn't need to be the case whatsoever. And of course, you know, in true fund manager style, we put up a line going from bottom left to top right, showing the relative performance of the fund over time to its peer group. But, you know, I for one, you know, would have said, if you'd said to me, you know, 10, 15 years ago, you know, does running an income, managing the income, running an income strategy sacrifice total returns over time? I would have said yes, potentially yes, that's the case. But you know, honestly, I've come to learn over the period I've been running this fund, which goes back much longer than you see on the chart there, right to the early 2010s. We ultimately have gained a benefit, in my view, from having the income strategy, and the reason being, having that income discipline forces you as a manager to make hard decisions at the times where they're hardest. And I'll give you a couple of little examples on that. One we touched on a little bit earlier. You know, back in 2020, when you know we're obviously in a shocking, nasty bear market, as my long-term clients will attest. You know, I'm pretty good at bear markets. I know what to do, essentially run away. So, you know, early 2020, we're aggressively cutting our equity exposure. At the same time, many of our investments are cutting their dividends and passing their dividends. So automatically, we're naturally selling those investments. But you have to, at some point, say, look, you know, we've got this looming income target coming in June. We need to make that. We need to make some difficult decisions. We have to, you know, reinvest all the cash we're holding and in income producing assets. And of course that, you know, with hindsight proved to be an extremely timely moment to be buying the equity market. We had a spectacularly good year that year, but we also managed to recover the income because we were almost forced by the income discipline to make that decision at that time. Another good example would be, you know, the UK pensions market, you know, this time crisis this time last year, where, you know, UK bond yields, US bond yields, in fact, bond yields worldwide were spiking up at the time, arguably because of forced selling by the UK pensions industry, although they blame Liz Truss these days. The actual thing that was going on in markets at the time was forced selling and margin calls on the UK pensions industry. Now, at that time, of course, I'm sitting there going, wow, look, I can get 8% yields on quality, short-dated investment grade corporate bonds, and my clients want income over time. Again, I become a natural buyer in a period of distress because I'm looking at the income stream going, I can lock in 8% yields for 3-4 years. Why wouldn't I, you know, in a fund that wants to pay out a decent income stream over a long period of time? So I've come to the conclusion over time that actually, you know, the income strategy benefits me as a fund manager and leads to higher total returns over time for the client. So there's absolutely no need to think income strategies will underperform. There's absolutely no need to think that you're sacrificing total return to get the income stream that your clients post-retirement want, deserve, and merit. So just to conclude, you know, ultimately the post-retirement market is really under focus at the moment. Many people are considering, do we need a separate investment proposition called a CIP in post-retirement? You know, obviously CIPs have been incredibly successful for the pre-retirement market, but we need to look at it differently, and the regulator is leaning on us to look there. Using your CIP post-retirement comes with huge risk and risks that I personally wouldn't want to take. There are very good reasons, you know, why historically we haven't used income strategies. Those no longer apply. Absolutely, the investment environment has changed, and it's changed massively in favor of investing in income strategies post-retirement. So for those three very big reasons, you know, regulatory focus, the risk of using your CIP, and the fact that income strategies are outperforming and will continue to outperform over time, really guide you towards using income for your centralized retirement proposition. But you need to find the fund managers who are actually managing the income in retirement. Thank you so much for listening.
Rounding off our multi-asset seminar, Kevin Doran, Managing Director, AJ Bell Investments. Kevin's been with AJ Bell since 2017 and took on the role of MD of D2C and Investments in 2022. His presentations are always thought-provoking, with his take on inflation, why central banks and many investors were caught on the back foot when the heat turned up, and how to protect portfolios if inflation is here to stay. Ladies and gentlemen, Kevin Doran.
Well, hello there, and thanks for that, Danny. Wonderful introduction. So we want to talk about inflation. You know, sometimes you wake up
and you pick up the paper and you look at the headline, you think, is this April Fool's Day? Well, that happened to me just a couple of months ago when I opened the FT app to be greeted by this. I'm still laughing today. To be greeted by this headline, Ben Bernanke, yes, that's Ben Bernanke, picture of him just so there's no confusion, to lead the Bank of England's review into forecasting. I laughed, spat my coffee out, and then changed the headline because it could easily have read Foxes to lead the Farmers Review into chicken population decline. It's quite laughable that Ben Bernanke, of all people, has been put in charge of this review. And I'll explain why I've got no confidence in Ben Bernanke's ability to lead that review as we go through this presentation. Along the way, we'll explain how inflation actually is created, and then we'll talk a bit about how you can protect against inflation and changes in asset prices as you're going through an inflationary cycle, something we've not seen for quite a while. So let's get on with the show. First of all, let's start off with, imagine you're a member of the MPC, Monetary Policy Committee. What's the MPC's current model of how inflation is actually created? So the Bank of England starts, as all central banks do, with looking at what can actually be produced by an economy in any given period, and that's aggregate supply. And they break this down. Effectively, there's only two ways that any economy can produce more in one period, moving on from an earlier period, and that's either you have more people doing roughly the same thing, or those people become more productive. So you have population growth and productivity gains. And if you want to think of GDP as digging a hole, you imagine you're digging a hole, you can make the hole bigger and increase the pace at which the hole gets bigger by putting more people to dig with their hands, or alternatively, you give one of those people a shovel. So that would be a population growth, more people digging with their hands, or a productivity gain, people using more labor saving devices so that you get more per unit of labor. And that would lead over time to a relatively smooth increase in GDP. But for reasons which we won't go into today, that's not how GDP evolves. And the reasons are essentially because there's human beings involved, and human beings have desires and wants, and they will fluctuate from time to time. And of course, there are certain desires that can only be satisfied in one period. People don't go out and buy cars on a daily basis. So if you buy a car, you're probably not going to buy another car for 3 to 5 years. And so you end up with these fluctuations in demand, and that can be plotted very stylistically here by an aggregate demand curve. Now, this is your starting point if you're a member of the MPC trying to understand how inflation goes, because the Bank of England, as I say, most central banks do, use something called the output gap model of inflation. What the output gap model does is it looks at positions where the economy and demand within the economy is exceeding the economy's ability to satisfy that demand. That would be a positive output gap. And of course, there are periods in time when the amount of demand within the economy is below the amount of productive potential within that economy. That will be a negative output gap. And the argument goes, using the output gap model of inflation, that periods where you have positive output gaps, they're inflationary because the amount of demand exceeds the ability to satisfy that demand, so it leads to bottlenecks, leads to pricing pressures, and prices ultimately go up. And the flip side of that is when you've got spare capacity in the economy because you're not using all of the productive potential that's available, people will try to bring that capacity to bear by lowering prices. So that would be a deflationary kind of signal. And the idea behind central banking models is, well, what if we anticipate these fluctuations in demand? What if we also monitor the productive potential of an economy? And as a result of that, we use the lever of interest rates, the price of money, in order to quell demand when there is overheating in the economy, and to stimulate the demand when there's insufficient demand within the economy. And in doing so, you flatten out that demand curve and it becomes much more predictable. You've got rid of boom and bust, to quote Gordon Brown. And as a consequence, you don't have periods of strong inflation, strong deflationary pressures, and therefore you've quelled inflation. That's central banking in the modern environment. Boom and bust is gone, but it's got one inherent flaw. And the inherent flaw is it's a load of rubbish. The output gap model of inflation has failed on multiple occasions. And if I was a scientist rather than an economist, when you conduct an experiment and you think of a model of how the world works, when you see data that contradicts your model of how the world works, you go back to the drawing board and you change your model. That's not what economists do. And I can give you a number of examples where economists have not done that, and they would have gotten rid of the output gap model a long time ago. This is a picture from Britain in the late 1970s and early 1980s, and we had a period of 5 quarters from starting 1980 to the middle of 1981, where UK GDP fell. So this is a period of insufficient demand within the economy. So GDP fell by 5%, but prices, as measured by RPI inflation in this case, went up by over 27%. So you've got a period where insufficient demand within the economy, but prices are going up. That's an absolute contradiction of the output gap model. Now, economists would jump in at this stage, and if there are any economists listening, you're probably already shouting at the screen. But Kevin, you're ignoring the fact that we have different types of inflation. There's cost push inflation, there's demand pull inflation. I would reject those, and I'll demonstrate why in a moment. That is, inflation is, was, and always will be generated by monetary features, and I'll demonstrate that looking elsewhere. This lady here is not celebrating the NHS. This is actually a picture from Argentina from about 20 odd years ago. And it's a well-known protest movement within Latin American countries. When you're not happy with the government, that you bring out your pots and pans and you bang them. They're the cacerolosas. So it's slightly ironic that at a time when we were trying to celebrate what the government and the NHS were doing during COVID, we brought our pots and pans out and banged those. This is actually a sign of protest. And this lady is rightly protesting because in Argentina, in the 4 years between 1998 and 2002, Argentinian GDP, Argentinian output, fell by nearly a fifth, but inflation rose by 240%. And actually, a slight sidebar here, this is where the idea for supermarket sweep came from. So in Argentina during this period, people would run around the supermarkets, and they would run around the supermarkets because the price rises of the basket of goods that you were collecting would be announced over the tarot. So the longer that you loitered in the store, the higher the prices would be when you got to the checkout. So people ran around the supermarkets, giving people an idea for supermarket sweep. And if I take this on a little bit further and give you the most extreme example, this is a picture from Venezuela. And if you listen to Dan's presentation, you know that these people are not queuing up for a refund from Gregor McGregor, they're actually queuing up to buy a pint of milk. This is the state of the Venezuelan economy since the Chavez era. So Chavez printed lots of money, as we'll discuss in a moment. And from 2014 onwards, Venezuelan GDP is down by almost 3/4. And inflation, yes, you are reading that right, is up by 658 million%. These people are queuing to buy a pint of milk. So what is the common theme? We've hopefully I've convinced you now that output gaps are not the mechanism by which inflation is created. And I'm going to argue that money is actually the reason why inflation gets created, because without money, there can be no inflation. And monetary statistics have been used at various points by economists to try to predict inflation, until eventually the Chicago School was booted out in the 1980s, and people said that there was no correlation between inflation and money supply. And arguably, if you look at the 1-year statistics, you can understand why they came to that conclusion. Here we've got a chart of 1-year inflation versus 1-year money supply growth, inflation being on the y-axis there. And you can see that's pretty much zero correlation there. There's an element of correlation, but not enough correlation that you can hang your hat on. That's 1 year. And so as a consequence, money statistics were largely removed from economic forecasting when it came to predicting what inflation would be. However, though, if you have a look at inflation measured against money supply growth over a longer period of time, 20 years in this case, you see the correlation becomes much stronger as you go through time. And there's a reason for that. Ultimately, there's 2 things you can do with money. You can use money to buy new things, so a new hat, a new scarf, a new suit, a new coat, a new haircut, a new meal. All of those things would show up in GDP numbers, and they would also show up in CPI or RPI-based inflation measures, because CPI and RPI measures the prices of things that we buy and consume on a day-to-day basis. It's basically shop price inflation. However, there's another thing you can do with money. You can use money to buy old things. So you can buy an old suit. Yes, you can buy a second-hand suit, second-hand haircuts as a wig. But primarily, most of the things that we in the financial services industry, we deal in second-hand goods. So all of the bonds, all of the currency, all of the equities, all the commodities that we trade within our portfolios on a day-to-day basis, they were all produced a long, long time ago. They're second-hand goods. It's only new issues, so initial public offerings, there would be new equity issues. But most of the equities that we trade in our portfolios on a day-to-day basis are equity that was created a long, long time ago. We are the world leaders in the trade of second-hand goods. So when money is used to trade not in first-hand goods, but in second-hand goods, it doesn't show up in CPI. It doesn't show up in RPI. Instead, it shows up in asset prices. And so you can have periods where you've got excessive money supply growth, will not show up in CPI and RPI inflation, but absolutely shows up in asset price inflation. And if you look at what's happened post-financial crisis, 2008 for the past 15 years, we've had a long period of excessive monetary supply growth, which has not been correlated with strong inflation, but has been correlated with strong asset prices. And this is where the feedback mechanism comes in, because ultimately those asset prices ultimately turn into higher inflation. People take property as a prime example. So when property prices go up, that means the cost of labor, to build those properties goes up, cost of materials to build those properties also goes up, and the cost of capital to build those properties also goes up. So that asset price inflation ultimately trickles down into real world inflation. And that's what we've seen in the past 18 months or so. That asset price inflation caused by excess money in the system has now manifested itself in higher RPI and CPI based inflation. And the Bank of England knows this, because the figures I've been showing you just there are taken from an article, and the Bank of England has known this for a long time. It's from an article written by Mervyn King, who was at the time Deputy Governor, now is former Governor of the Bank of England. And he talked about this in an article actually entitled "No Money, No Inflation." And he really highlights the point here, which is there are real dangers of relegating money to this behind the scenes role. We have to keep on top of what's happening with money supply if we're going to keep on top of what's happening with inflation. And it's on that basis that I've got absolutely no confidence in Ben Bernanke's ability to draw the same conclusion. Because Ben Bernanke became head of the Federal Reserve on the 1st of February 2006. And what I'm showing you here is a release on March the 9th, 2006. So almost the first thing Ben Bernanke did as leader of the Federal Reserve was discontinued money supply data at the Federal Reserve. So they no longer produce a broad money supply numbers, which was M3 in the US. It's M4 in the UK. So I've got absolutely zero confidence that Ben Bernanke is the right person to take on that job. So hopefully by now you're thinking, okay, well, if money supply is so important in predicting inflation, maybe we can take a look at what's happened with money supply. Well, yes, we can in the UK, because we still produce, the Bank of England still produces M4 broad money supply data. And here's the numbers. So you see, back in the 1980s, there was a couple of $100 billion of money in the economy. That's now over 3 trillion. So there's 3 trillion of cash held in the UK banking system. And that's what you're measuring when you look at broad money supply, how much money is held in the banking system. And you'll see that this is a relatively smooth curve. So it's not dissimilar to the aggregate supply curve that we looked at on one of the earlier slides, but there are notable bumps. So if you look in the period from 1988 to 1992, you'll see that there's a period where it accelerates in the late 80s and then flattens out in the early 90s. That period in the late 80s was the Lawson boomlet. So the economy was really strong in the UK in the late 1980s, but that prefaced the recession from 1990 to 1991. And that's that flattening out in the money supply curve that you see. Then it grows at a reasonably constant pace until about 2004, where it then really ramps up. And that ramping up from 2003, 2004 is as a function of we just reduced interest rates across the globe from previously around 5 to 6% to closer to 1, 2, and 3%. So that rapid reduction in the price of money stimulated the demand for money, and the banks were in a position to provide that money through the lending process. And money supply runs away all the way up to 2008, 2009. It flattened, absolutely flatlines from 2008 to 2009. And what I would say is, had it not been for quantitative easing, the destruction of money, as money is destroyed when a bank has to write off a bad loan, when it's created when the bank creates a new loan, had it not been for quantitative easing, money supply would have fallen in absolute terms, and the state of the economy would have been much, much worse than what we actually saw from 2008, 2009, and 2010. Quantitative easing really kicks in from 2010 onwards. That's that sharp line up that you see there. And then it flatlines for a long period of time, which is the age of austerity that we're familiar with. But like I say, what you're seeing there is an offset of money supply being destroyed in the banking system because the banks are not creating new loans and they're writing off bad loans, offset by quantitative easing, which is about leveling things out. Then we get to 2016, the banks have fixed their balance sheets, so they're now in a position to start lending money again. And banks have been expanding their balance sheets from about 2016 onwards. We end up with stronger growth, and then COVID hits, and we do an absolute fundamental monetary mistake. There's nothing wrong with the banking system during COVID, but yet we still engage in quantitative easing, and that's that hump that you see in the money supply, which has taken us over that 3 trillion figure. You'll also notice though that it's leveled out in recent months. So the question that's been posed in other presentations is, are we about to go into a recession? The answer is no. We're already in a recession. When the data is eventually collected, I will argue reasonably strongly that the UK economy went into recession in July 2023 and will probably stay in recession for about 6 to 9 months at least. So that's the figure, that the information we can draw by looking at what's happened to money supply. And it also explains why we've now got a period where, in the absence of asset price increases, why we're seeing strong increases in CPI and RPI based inflation. So what should you hold in your portfolio if you're going to an inflationary environment? Well, if I'd have asked this question 2 years ago, most people would have said the stock answer. Family fortunes would have said, absolutely, I need index-linked bonds in my portfolio to protect me against inflation. Okay, so let's take a look at what happened to index-linked bonds during a period of high inflation. So this is the 10-year and the 30-year price return. So that's the 10-year index link and the 30-year index link for the first couple of months of 2022. And the reason I'm showing you that particular period is it's middle of February 2022 when Putin marches into Ukraine. And if you listen to most commentators and forecasters, they will tell you that's the reason. That is the single reason why you end up with higher inflation in CPI and RPI based measures. So we're about to go into a period of high CPI and RPI based inflation. What's going to happen to index-linked bonds? Well, there you go. That's what happened to index-linked bonds. The 10-year from that date when Putin marched into Ukraine is down minus 16%, and the 30-year bond is down 60%. These are supposed to be, this is government-backed bonds, supposedly risk-free. The index-linked bond is down 60% in an inflationary environment. That is not an index linker, that's an index stinker. That's an awful investment to hold in an inflationary environment. And the reason people have been completely ignorant of this is they've focused on the word index linked and they've forgotten the word bond. Because when bond yields go up, bond prices go down. And if you go back to the point where Putin marches into the Ukraine, the 30-year index-linked bond in the UK was on a negative yield, yes, a negative yield of over minus 2%, and the 10-year was on a negative yield of over minus 3%. So let me just run through that. If you're holding the 10-year bond on a negative yield of minus 3%, over the next 10 years, no matter what inflation does, you will underperform inflation by 30%. So if inflation was 10, you'd do minus 20. If inflation was 30, you'd do 0. If inflation was 1,000, you'd do 970%, but you were guaranteed to underperform inflation for the rest of the holding of that bond. Similarly, if you do the same numbers for the 30-year bond, and 30-year bond on a minus 2% yield, you're going to underperform inflation by minus 60% over the life of that bond. And so what we've seen since then is a readjustment in what's happening to real yields. But these real yields are still not attractive. A real yield of minus 0.5% on a 10-year bond and a 1% real yield on a 30-year bond is still not an attractive yield. So despite some of the falls that you've seen in index-linked bonds, they're still not in attractive territory. And even then, a 30-year index-linked bond will outperform inflation by only 30%, 1% annualized over the next 30 years. That's still not a really attractive thing to hold in your portfolios to protect you against inflation, because it's the change in the real yield which makes it far more sensitive to makes the price far more insensitive, and the index-linked component is really blown away by what happens to real yields. So let's try something else, because family fortunes answer number 2 would always be gold. I'm going to an inflation environment, I need to hold some gold in my portfolio. And sure, if you look at the gold price over the last 100 years, it's gone from practically zero to just under $2,000 per ounce. At this moment in time, it looks like a fantastic return, but let's just adjust that data and put it in real terms. So in real terms, this would be in 2023 prices, this would be the price of gold. And I can point to 2 periods there. So a 39-year period from the end of start of the war, sorry, where gold underperforms inflation. And then a 43 years and counting period from 1981, where gold has underperformed inflation. Look at the volatility that you've had along the way. The idea that gold is an inflation hedge just is not backed up by any of the data that you're looking at here. Yes, on 2 occasions where you've seen a spike in inflation, there's been a corresponding spike in gold, but they are sporadic and only 2 data points. Gold is not an inflation hedge. And so I think that's another thing that we can throw out of the inflation protection within your portfolios. So how do you hedge against price increases? Well, let's take a look at that gold price. That's the gold price in real terms, which we just looked at before. But when inflation's going up, that means the price of the things that you're buying on a day-to-day basis, your mobile phone bill, your petrol, the things that you're buying in the shops on a day-to-day basis, that means the prices of them are going up as well. And so in organizations and companies where you recognize these logos, because yes, they're companies that you know well, but they're also companies that reside within your client portfolios. So when the prices are going up and these people are putting their prices up, that means their revenues are increasing. Sure, it probably means their costs are increasing as well, but most companies are really good at controlling their costs and controlling their margins over reasonable periods of time. So in an inflationary environment, these revenue increases will eventually lead to higher dividends and higher share prices. So what I'm showing you here is over the past 100 years, the S&P in real terms as well, which has significantly outperformed the price of gold. Now you might look at the chart and say, hang on a minute, that doesn't look like it's significantly outperformed gold at all. And there's periods where it's underperformed. That's because I'm showing you on a different axis. Yes, the price of gold in the last 100 years is up 400% in real terms. The price of equities is up 120,000% in real terms. So if you like that on the same axis, that's what it looks like. The only real hedge you have against inflation is equities. But equities will not protect you in the short term against inflation, in the same way as index-linked bonds do not protect you in the short term against inflation. So the thing you need in your portfolio is not bonds, it's not equities, it's not commodities, because nothing protects you against a sudden increase in inflation in the short term. It's only over the course of a cycle that things fall back into place and you end up with better returns against inflation and holding real assets in your portfolio. The thing you need in your portfolio is not what we've talked about today, bonds, equities, commodities, and the like. What you need in your portfolio is time and patience. And that's why the job of the financial advisor is so important, particularly in periods of turbulence like this. I know it's very tempting to look at interest rates on cash and see 5% returns, but inflation is still over 5%, it's still a negative real return. The thing that you want within your portfolios, and we all know that equities and bonds, etc., move rapidly during times of uncertainty. The thing that you need in your portfolios is time. So hold your portfolios and hold your clients' hands. The people in the room that are important are not myself and the other presenters that you've heard from today. The most important people and the most important thing you can have as an investor in times like these is someone who knows what they're talking about, is calm, is able to explain what's happening with marketplaces and hold the client's hand through these periods of inflation, through these periods of uncertainty, and allow the client to come out on the other side, holding a portfolio of real assets which will protect them against inflation. Thanks for listening. I'm going to pass you back to Danny.
Thanks so much, Kevin, and that is your lot. Thank you to all of our speakers. Don't forget to fill in your feedback forms, which will pop up at the end of this webinar, and send any questions for our speakers. We'll make sure that they get to them and the answers get back to you. We'll email CPD certificates and slides ASAP, and the recording will be available shortly on the Info Centre in case you want to recap any little nuggets, or just because you have a friend or colleague who you think would be interested. As I said at the beginning, we are keen that this content reaches as many people as possible. For all of us here at AJ Bell, thanks so much for taking the time. We hope to see as many of you as possible at our next in-person event. Until then, thanks for watching.